The level of uncertainty is extremely high.
Things seem to be in a free fall. You don't want to catch a falling knife.
Equity markets and markets generally are resilient.
We still see a compelling stock or equity story ahead.
It's just so difficult to determine what's going to happen next in this market.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday, the war enters week 5. Brent crude adding to the biggest monthly gain on record as Iran-backed Houthi militants are beginning to enter the conflict. And the Post indicating the Pentagon is preparing for a ground operation. Escalation risk is rising.
And we're seeing oil poised for the biggest one-month gain on record as people start to reckon with this sort of escalation risk. You're starting to see real fear bake into markets. Not only are you starting to see the concern about some sort of slowdown being expressed in bond markets, but you're seeing 5 consecutive weeks of losses in the S&P 500 for the first time going back to 2022, and a feeling this isn't going to be a short conflict.
And attempting to work out to process what the president's talking about in a conversation with the Financial Times. To be honest with you, my favorite thing is to take the oil.
Right. I think what he's talking about there may be Kharg Island, where 90% of Iran's oil has to go through that island as it goes through the Strait of Hormuz. Potentially, that is one option that is on the table. There's a lot of reporting, though, Jonathan, not just from the Washington Post about the ground invasion potentially with thousands of troops already in the region, but also the Wall Street Journal had this out overnight, that the president is weighing a military operation to extract nearly 1,000 pounds of uranium from Iran. So at this moment, it does feel like the president is keeping all options on the table because he told reporters last night on Air Force One that maybe this week there'll be a deal via the Pakistanis.
Lisa mentioned the bond market move. Let's talk about it. 2s, 10s and 30s. Yields lower across the curve so far this morning. 10s down by 3 to about 440. You will have noticed going into the weekend, the stocks closed at the lows, and so did the 2-year yield. Are things getting so bad it's good for fixed income?
Yeah, and I keep thinking about what we were talking about with Bob Michael of JP Morgan Asset Management last week when he said, you've seen a technical move, a washout of positioning, and we now can have a healthier kind of trade in the bond market. Suddenly, people are worried about second-order effects, the disinflationary ramifications, and frankly, the suppression to growth as a result of high oil prices. You're starting to see that baked into multiples. You're starting to see that baked into the bond market. How far can that go?
Crude. Check out the new forecast. These from SocGen and Michael Haig. We expect Brent to average 125 through the month of April and credible spikes towards 150. That's the latest from SocGen. They lift their 26 year-end Brent forecast from $65 to $80 a barrel.
This is because right now, what you have in the paper market, it is nowhere near the higher elevated prices you see in the physical market, especially out of the Middle East. And guess what? Things over the weekend got even more complicated when the Houthis decided they were going to enter the war. At the moment, the Red Sea, Bab el-Mandeb Strait, there flows when it comes to cargoes and vessels. But the Houthis have shown that they have the capability to go after those ships. And then at that point, you'd be looking at Strait of Hormuz closed as well as Bab el-Mandeb Strait. You have 2 choke points in the Middle East.
Futures this morning doing a little bit better. It's a bounce following 5 weeks of losses on the S&P 500, up by just 1/3 of 1%. Coming up this hour, we'll catch up with Calvasina of RBC, with stocks on a 5-week losing streak. General Mastin Roberson of Academy Securities as the U.S. forces build up near Iran. And Bob McNally of Rapidan Energy Group with crude back near multi-year highs. We begin this hour with that top story. Fresh strikes ripping across the Middle East as President Trump threatens to take Iranian crude. Bloomberg's Jemana Bisechi leading our coverage out of the region and gives us some time this morning. Jemana, welcome to the program. I read that quote from the president to the FT. To be honest with you, my favorite thing is to take the oil. What's the reaction across the region this morning?
Well, the reaction is that there has been no progress on the diplomatic front. And, a little earlier on in the day, when President Trump was speaking to reporters, he seemed to suggest that maybe Iran would come to the negotiation table and that perhaps there is a possibility of signing a deal in the next few days. And you saw futures and stock markets turn on that. But the reality on the ground paints a very different picture. And to your point, President Trump seems to be implying that more military action is forthcoming. We were talking about the arrival of that first unit, the Marine Expeditionary Unit. It came to the region on Friday. 3,500 troops, about 2,200 Marines. questions really about where they're going to be deployed. Remember, this isn't a huge number of troops, and they would be capable of perhaps going into these targeted raids. There's been some discussion about a potential takeover of Kharg Island, obviously very risky. Wall Street Journal also reporting that they could be deployed into inland territory and perhaps look to conduct an operation to take out that enriched uranium stockpile. But again, a very risky operation as well. Or they could be just sent there as a means of deterrence. The reality is we just don't know. But in terms of the military operations over the weekend, I will tell you, once again, we have seen a massive uptick in intensity. On Friday evening, Israeli operations conducted some strikes against 2 steel facilities in Iran, some nuclear research sites, and in retaliation to that, Iran once again lashed back at Gulf states' infrastructure, hitting 2 key aluminium smelters in the region. That's having an impact on aluminium prices this morning. A key airbase in Saudi Arabia, the Prince Sultan airbase. The U.S. sustained some critical damage there on some of their own jets. Also a desalination plant in Kuwait. And then add to the mix, as you were just talking about, a new front has opened up, which is the very fact that the Houthis have decided to enter into the conflict. They launched some attacks on Israel on Saturday morning. And the big question from here is whether they are going to start disrupting shipping again in the Red Sea. And just a bit of a history reminder here for viewers. The Houthis did sign a truce with Saudi Arabia back in 2022. They also signed a truce with the U.S. in May 2025. Since the Israel-Gaza ceasefire of October 2025, they have not done anything on the Red Sea, but they reserve the right to do so. And I think this is the big risk as we head into the next couple of days, and whether really another front in this conflict opens up, not just on the Persian Gulf, but also now on the Red Sea. And given how much oil Saudi Arabia has managed to divert from the Persian Gulf to the Yanbu port, clearly a risk for oil markets as well.
Let's see if that truce holds. Jemana, thank you. Appreciate the coverage as always. Jemana Basechi there, leading our coverage out of Dubai. Policymakers are scrambling. You're seeing it around the world. Qatar cutting rates. Australia halving its fuel tax for several months. South Korea considering expanding driving curbs. The latest from the Bloomberg team earlier on this morning.
It's a physical problem, particularly in Asia, particularly in South Korea, even throughout the region, with a question of physical goods not getting delivered. And that's the sort of difference a lot of commodity strategists keep pointing out.
Let's get to the view on Wall Street this morning. This from Calvasina of RBC, writing, stock pickers can be reluctant to bake in macro concerns until their companies start to openly worry about them. It may simply take more time for the equity community to fully understand the impacts from an extended conflict. Laurie joins us now for more. Laurie, good morning.
Good morning.
We've had a correction of almost 9% on the S&P 500 from the highs. There's some multiple compression in there, which begs the question, is this an opportunity? At the same time, we haven't cut earnings expectations. So what's your advice this morning?
So, look, I think we kind of have to take it one day at a time, and I know that's not a satisfactory answer. But the reality is that, you know, at 8.7% from the January peak, we are still within what we would call a Tier 1 drawdown. Now, if you go back to the financial crisis, we've actually seen that there, and you kind of use that as your starting point, we haven't had any drawdowns if you take the post-GFC high that have ended up between 10 and 14%. If you go past 10, you're going to the teens, right? And there's a little bit of an air pocket between the two. And I think what we're confronting right now is if this is going to stay relatively contained, right? If this is going to be relatively short duration. You've seen things like AAII net bulls are between -1 and -2 standard deviations. That's enough. But if we are going to have a more extended conflict and we're going to start sort of saying, okay, this isn't just an inflation shock, it's a growth shock, the U.S. is not as immune as we thought, that is something that could take you into Tier 2 drawdown territory. Growth scares tend to involve periods in which something new happens, we don't understand it, it feels like things are out of control, and people genuinely start to fear a recession. We are not there yet, but we have to keep a very close eye on the narrative to see if that's where it's headed.
I'm sure clients are all asking you the same question. Is it an inflation shock, a growth scare, either or just a sequencing question?
I would say that most clients, so I was on the road for 4 days last week, and what we essentially saw was that most clients are more in the, this is going to create some inflationary pressures camp. We are seeing a lot of people sort of defend the resilience of the economy, the strong point coming in, and to be fair to those clients, you are seeing this in all of the C-suite survey data that has come out, including ones that had a little bit of the post-war period in them. You're also seeing, I have read, I think, everything and S&P 1500 or Russell 3000 company has said at a conference or on an earnings call, and I've read all the SMIDs because they give you great information in this period, but they are generally, for the most part, still sort of talking about this resilience, their ability to work around things. We're seeing a few companies make adjustments in terms of things like fuel costs or guidance, but not a lot. And so this is all going into the ears of the U.S. equity investors. Now, I will tell you, John, as the week wore on last week, I started to get a couple questions about growth impacts towards the end of the week. I had one client sort of say, if we look at what's going on in Europe and Asia, can the U.S. really stay immune from that? This same client thought that this conflict would go on a few months. He was the only person last week who told me it would go on a few months. Everyone else was debating 1 week or a couple of weeks.
Based on the fact that you've seen profits reaccelerate, actually, earnings expectations continue to increase, do you think this market's being overly complacent, or do you think that we're close to a washout that seems like a buying opportunity?
I don't think that we are being complacent. Frankly, and I kind of knew this heading into last week as well, but we are seeing a lot of people not doing a lot. Like, they're fishing around for trades. They're trying to figure out what to do. We know a lot of hedging activity has been put on, and people don't feel great. That is not complacency to me. But at the same time, we have seen the bottom-up S&P 500 EPS forecast. It was like at 313 to start the year. Then it dipped down to 312, and now we're all the way up to 323. And we just added $3 over the last week. So, you're seeing this help out the multiples. And if you look at the S&P bottom-up market cap weighted PE, we were at 28 times last fall. We were up around 25 times earlier before the war started, and then we are now, sitting down around 21 times. Now, I don't think it's a washout yet, because you are not at the average, which is 18.5, and in 2022, when the broader market bottomed on that 25% drawdown, you dipped a little bit below the average. So is it improvement? Yes. Is it helpful? Yes. Is it a hold your nose and buying opportunity? I don't think we're quite there yet.
The more that the bond market thinks that this is potentially a growth scare, does that add to the attractiveness of stocks, given the fact that we've done all of this with increasing rate expectations? Yeah, so look, I think that when I talk to investors, nobody, at least in my meetings, is looking for rate hikes, right? I think what we're much more sensitive to are 10-year yields. We actually worsened one of our stress tests. We had been looking for 4.5, sort of in like the $100 extended oil scenario. We took our inflation numbers up in our stress test. We took 10-year yields up to 5. That tends to be the number that spooks equity investors. But I'll tell you, Lisa, I had like 5 flavors of earnings in this stress test, keeping like that 15% growth that's in the consensus now, and then going all the way down to 10% contraction versus 2025. I'm coming up with a range of like 5,700 to 7,400. And if you look at kind of like the more benign earnings assumptions, you can get a flat market this year, even with some pretty onerous numbers. So we have to pay attention to what's going on with earnings. We have to pay attention to what's going on with the inflation rate. But the 10-year yield is also a key variable, and the lower it is, the better it's going to be for the multiple.
We've got some big names in a lot of pain as well. Just last week, Microsoft down by close to 7%, Meta down by double digits. I know you won't do single names, but let's talk about big tech.
Yeah.
A lot of these issues predate this war. Is this war becoming a convenient excuse for something that was already developing?
Well, look, I think that we benefit in the U.S., and it kind of leveled out mid-month, but, we sort of saw initially in this conflict that the U.S. was benefiting as a safe haven trade, outperforming the rest of the world. And if you look at PEs for U.S. versus Europe versus Canada versus Australia, so just take like a landscape of global developed markets, we were seeing the S&P PE coming down heading into this crisis. And so we already had a lot of de-risking on private credit fears, on AI fears, which really, frankly, perked up last Labor Day. At the same time, these other markets, their PEs were moving up. So we got to this Iran conflict, and the U.S. had lost its valuation premium if you looked at a 5-year average. And if you even looked at a 20-year time frame, we had lost that valuation premium in the U.S. as well. So, the earnings are still looking pretty strong in that mega cap growth cohort. We've seen the rate of upward revision skyrocket in the top 10 market cap names back to last fall's highs. And if you look at that 323 number I mentioned, and you just look at like a 26 growth rate versus 25, tech is the thing that's driving the way. So you also have to figure out a way, if you really want to push this market into really negative territory in a sustainable way, you've really got to attack those tech earnings.
Laurie, it's good to see you.
Good to see you.
Thanks for dropping by. Thank you. Laurie Calvasina there of RBC Capital Markets. Pretty phenomenal. Amazing. Just try and get your head around this. Crude has ripped. The biggest monthly move we've seen on record if we close at these levels. And yet here we are, pricing in a better outlook for earnings on the S&P 500.
Jurriën Timmer put it really well over at Fidelity. He said the S&P 500 index is down 9.2%, but the PE ratio is down 18%. This is all being led by multiples going down, even though the earnings are actually increasing. And this speaks to a lot of the positivity that you're hearing under the hood.
Futures on the S&P positive by 1/3%. Let's get you an update on stories worldwide with your Bloomberg brief. Yahara has more. Hey, Yahara.
Good morning, John. President Donald Trump says he's ready to make a deal with Iran. Speaking to reporters on Air Force One, the president saying Iran is giving the U.S. most of the demands from its 15-point peace plan. Iran still disputes their negotiations. A confirmation hearing for Kevin Warsh could be held the week of April 13th. Punchbowl reporting the Senate's Banking Committee is planning to hold a hearing for President Donald Trump's nominee for Federal Reserve Chair in 2 weeks' time. And President Xi Jinping inviting Taiwan's main opposition leader to visit mainland China, setting up a high-stakes meeting weeks before a planned summit with President Trump. Chang Li-wan will visit China from April 7th through 12th, marking the first such visit in nearly a decade. That's your Bloomberg Brief, John.
Yahara, thank you. More from Yahara later this hour. Up next on the program, looking for a deal.
Could you foresee a deal in Iran this upcoming week?
I do see a deal in Iran, yeah.
Mr. President.
Could be soon. But you never know with Iran because we negotiate with them and then we always have to blow them up.
Up next on the program, we'll catch up with General Roberson of Academy Securities. Live from New York City this morning. Good morning. Here is your week ahead later on this morning. Check it out, 10:30 a.m. Eastern Time. You will hear from the Fed chair. That is going to be must-listen and must-watch later on this morning, going into a big week full of economic data. How important is this data? How dated is the data, Bramo, coming this week?
I actually think we'd always be focused on the jobs report, but instead, on Wednesday, we get ISM manufacturing and prices paid, and that might be the most important data point of the week because everyone's looking for the real-time increase in costs to companies. That might be the fastest and most current look we can get on that.
Heading into that week full of data, equity markets look like this. Futures positive by 0.4% on the S&P, up 1/3 on the Nasdaq. In the bond market, yields lower by 3-4 basis points on a 10-year, 4.39, and in crude. A record-breaking rally for the month so far. Brent 115 and up another 2%. Under surveillance this morning, looking for a deal.
The one regime was decimated, destroyed. They're all dead. The next regime is mostly dead. And the third regime, we're dealing with different people than anybody's dealt with before. It's a whole different group of people. So I would consider that regime change.
Could you foresee a deal in Iran this upcoming week?
I do see a deal in Iran, yeah.
Mr. President.
Could be soon. But you never know with Iran because we negotiate with them and then we always have to blow them up.
So here's the latest this morning. The Iran war showing no signs of letting up. The U.S. sending thousands of additional troops to the region as Annmarie, Iranian-backed Houthis join the conflict.
And I think this is really a massive escalation risk at the moment. We do know that the Houthis have the capability. They did this in 2023 in terms of going after vessels in the Red Sea. And right now, the Red Sea has become critical for this crisis because over the weekend, we also got other news. Saudi Arabia's East-West pipeline is now at capacity of what it's able to move through that pipeline. It is now moving 7 million barrels a day. This is a huge feat for Saudi Arabia, but all of that oil is going to Yanbu, which is on the Red Sea. And if the Houthis decide to close the Bab el-Mandeb Strait, which is between Yemen and Djibouti, this will be the second choke point. And then you could see prices escalate very quickly.
That's the nightmare for the energy market. Brent crude this morning at 115. General Roberson of Academy Securities writing the following. Iran's actions, left unaddressed, potentially sets an illegal new normal. General Roberson joins us now for more. General, welcome to the programme, sir. Can we pick up on Houthi militants entering this war, this conflict? What are the consequences of that?
I don't know it really changed anything. I believe the Houthis have been involved the whole time. I think what we're missing here is that the Houthis do not make their own decisions. They're a proxy. And they act when Iran says, okay, we want you to act. And when Iran wants them to stand down, they have them stand down. Nobody controls the Houthis except for Iran. And certainly Yemen doesn't control the Houthis or those frontier spaces that are within their border.
One individual, though, John Lieber of Eurasia Group, said to me that the Houthis would rather be basically paid off by the Saudis instead of getting involved. Do you think the calculus is changing for the proxy?
I I don't think it changed for the proxy because but I think the Houthis are businessmen. Yes, they'll take money from the Saudis, and yes, they'll promise A, B, and C. But at the end of the day, the Houthis are owned by the Iranians. And the question is, do the Houthis really believe there's still sufficient supreme leadership authority in Iran for them to be able to trust that that's where their calculus, their money, their direction is going to come from? Or has this second or third generation of supreme leadership authority dissipated sufficiently to where they start to doubt? I have confidence that given the decades-long relationship Iran has with its proxies, although not decades long necessarily with the Houthis, Iran still has a firm grip, in my opinion, on them, largely not because of the Supreme Leadership Authority, but because of the IRGC that is below that, but is intrinsically connected to the Supreme Leadership Authority.
We do, though, have a recent killing, according to the Israelis, of the IRGC Navy commander. Do you think this breaks down their maritime command for the Iranians?
No, I think you've got to get into the tens of thousands, if not 100,000s, of killings of the IRGC if you're really going to have an influence and effect. But I don't think we really know. We know that they're 250,000 in theory strong. We know that they are just etched in stone in relationship with the Supreme Leadership Authority and have been since the beginning. We don't know how deep that etched in stone authority and loyalty goes, but we surmise it goes pretty deep, which is why I don't think what the goal here is, how do we destroy the IRGC? The goal is, how do we get Iran to a point where they're willing to negotiate a plausible non-nuclear Iran in the future? And to me, that's where the entire buck stops, is how do we get Iran to where they are not pursuing a nuclear capability that would be catastrophic for the world?
Well, how do you think we get there? We're not there now today, are we?
We are not. But I think that's the reason you're seeing more forces sent there. Everything is about leverage. Everything is about how to create negotiation space. How do you create enough, not pain, but how do you create enough capability, threat, and anxiety that is all of this calculus combined together of, the killing of the Supreme Leadership Authorities, the reduction of their capabilities, particularly the destruction of their Navy and a lot of their air, to say how much more are they willing to sustain and be able to say we're still an entity to be reckoned with in the Middle East.
General, when President Trump says that he wants to take the oil in Iran, how do you understand that?
I see all this as purely negotiation strategy. If he can see something that causes the Iranians to say, okay, I didn't expect that, that's a bridge further than I wanted, then I think that gives the upper hand to what the administration is seeking. What I don't see this being is a ground invasion like, Iraq. I don't see that is where we're headed. I do see where we're headed is where the leverage points that the administration believes are plausible, and it's really the leverage points that CENTCOM believes are plausible, because there isn't any surprise that we're doing something against Iran at some point. It's just the timing of when. But every regional combatant commander has in-the-can campaign plans and plans against certain scenarios that they break out, dust off, update based on how the situation has changed. And then they expand it based on what the current administration will allow and authorize them to do it. Most regional combatant commanders are willing to be a little more aggressive than their electoral officials are telling them to be. So there's always that calculus of the military wanting to be a little more aggressive and confident, the administration and the elected officials saying, well, wait a minute, there's more at stake here than just winning a battle on the battlefield.
General, well framed, as always. It's good to see you. Thank you, sir. General Mastin Roberson there of Academy Securities. Another Monday morning that started on Sunday evening.
Always. I was thinking to myself, it's going to be one of those days, and my goodness, the oil price tells you everything.
Up next on the programme, we'll catch up with Bob McNally of Rapidan Energy Group with Brent crude over 115. Coming off the back of the biggest two-day loss on the S&P 500 since April last year, equity futures looking to bounce. We're higher across the board here on the S&P 500, up by 0.4% following a fifth consecutive week of losses on the S&P. That's the longest since 2022. That's the S&P 500. On the Nasdaq, no better. In fact, in some places, by some measure, worse. We're down by 10% in correction territory, down by more than that. Some of the big names last week got absolutely hammered. Not just Microsoft down by close to 7%, but Meta down by 11 percentage points. And much of the pain in some of those names predates this war.
And has something that is completely unrelated to the war, which is a court case for Meta that really undermines some of its potential safety controls on social media, and questions about AI advancements that are going to undercut some of Microsoft's software tools. So some of these issues have already been percolating. It's why it's the trifecta that people talk about. The software concerns and AI disruption, a concern about the oil shock, as well as the labor market, which still kind of sits out there as a potential risk factor.
More data on the labour market coming on Friday. Something happened in the past Friday. Something switched. Something clicked. And you would have noticed at the close, when we closed on the low in equities, we closed on the low on two-year yields. Check out yields this morning. The move continues. Yields down by 2 on 2s, down by 3 on 10s, 4.40 on a 10-year yield. Are we starting to price in the growth aspect of all of this into the bond market?
Over the weekend, note after note, Goldman Sachs, JP Morgan, TD Securities saying, look for that growth shock. That is a more significant counterbalance. Does this come when the market is more balanced, when you've already seen something of a washout of the technical positioning? But right now, people are starting to consider, wait a second, why are central banks going to hike rates into potentially what could be a growth slowdown?
A bit of pushback to that story. Yields getting pulled lower. Crude still pushing higher. The problems persist. 115 on Brent, close to 116. Squeezing out a sixth consecutive week of gains just last week. Brent up on the month by almost 60%. 60% for the month of March.
And this is because the fighting continues. We have seen even just overnight, Iran continues to get hit from Israeli and U.S. strikes, as well as Iranians going after still infrastructure and bases around the Middle East. And at the same time, although you've seen some reporting from Iranian news agencies that some vessels are able to go through, we're talking about a very low number compared to normal flows. Iran still controls the strait, and they're only letting certain ships pass through.
115.60 so far this morning. 3 hours away from the opening bar. The cash open just around the corner with your morning movers. Yahira has more. Hey, Yahira.
Hi, John. We are seeing the aluminum stocks gaining this morning with Alcoa up 8%. Century Aluminum also up 8% in the pre-market. Attacks on two major Middle Eastern producers are threatening one of the biggest disruptions this market has seen in years at a time when inventories are already tight. So we are seeing the price of aluminum on the LME surging. The industrial metal is used in everything from autos to airplanes to food packaging. We are also seeing oil stocks moving higher this morning. Exxon up 1.6% as this supply shock, already one of the biggest in history, moves past the 1 month mark, with investors seeing no end in sight. So we continue to see crude surging. As you said, Brent crude on track for its biggest monthly gain on record. And we end on Peloton. Those shares up 3% in the pre-market after being up nearly 9% on Friday, after investor Eric Jackson of EMJ Capital said he is long the stock, saying the market has not caught up to its fundamentals-driven turnaround. John?
Yahira, thank you. Thanks for the update. More from Yahira later on this morning. On our radar this morning, the war entering week 5. Iran-backed Houthi militants entering the conflict, launching ballistic missiles at Israel Saturday morning following U.S. and Israeli strikes on Iranian nuclear facilities. Elsewhere, the president claiming Iran is agreeing with most of a 15-point plan to end the war. Iran saying it rejected the plan and disputing Trump's claims about negotiations. Tehran insisting on its own 5-point plan, including war reparations. And finally, the president saying he wants to, quote, take the oil in Iran. In an interview with the Financial Times, the president saying the U.S. may take Kharg Island, the country's main fuel hub.
So a lot of questions around how serious this is. We were just talking to General Maston, who is saying that he thinks this is looking for leverage. I found this interview really interesting from the pushback that the president was given to all of the criticisms that he's been getting with respect to the war. It's going to cost too much, seize the oil. It's potentially, we're not getting anything. He said, well, actually, we got this big gift. You said it was BS, but actually it was a number of ships from Pakistan that were allowed to go through the strait, one after another. He's talking about how they've already had regime change. The people we're dealing with are a totally different group of people. They are very professional. All of these signal that he's paying attention to some of the criticisms out there that keep peppering his administration.
The individuals he's talking about saying they're very professional are like Mohammed Ghalibaf, which is out on Twitter constantly trolling this administration. He was out last night talking about what is going on in financial markets. When it comes to the oil comment, what struck me is that the president compared it to what happened in Venezuela. Preference would be to take the oil, comparing it to the potential move to Venezuela, where the U.S. intends to control the oil industry. The problem is this is so much harder to do in a country like Iran. How are you going to control the oil in a country that is still run by this regime, even though there's changes within, because there's been targets? And the fact of the matter is you can't unless you do take Kharg Island, because 9 out of 10 barrels pass through that island. And how long are you prepared to stay there and control that island? I don't see the U.S. wanting to go into a protracted war, which would mean troops on Kharg Island for months or years.
We had trade recommendations from the Iranian government going into the opening of market trading last week. What do you make of that, Bramo?
I mean, this is the key point, is that they want oil prices higher and the U.S. wants oil prices lower. And, you know, this is the job voting that you're going to get with a lot of potential AI videos that are really entertaining.
It's becoming somewhat farcical, isn't it, on social media at the moment?
Yes, actual physically, literally it is farce.
Brent crude on track for a record monthly gain as the war with Iran continues to intensify. Bob McNally of Rapidan Energy Group writing, fades speculation on a near-term US-Iran ceasefire. US force posture points to escalation. Bob joins us now for more. Bob, welcome. Let's start with that line. It's an important line. What is it about the force posture of the US that points to escalation?
Great to be with you, John. So, yeah, we're flowing. We have 1 Marine Expeditionary Unit's arrived. Another one's on the way, 82nd Airborne, and other forces are moving in. We think we're likely to see some form of ground operation. I'll doubt we'll go into Kharg Island. Most of the military folks I talk with just don't understand the utility of that. However, there are smaller islands that are more defensible. They're used by Iran to interdict shipping. Perhaps it's those. But I think some form of U.S. ground force insertion is coming.
But, Bob, when we talk about the president saying things like, I want to take the oil in Iran, inevitably that would mean some sort of operation with Kharg Island, no?
You know, it doesn't have to. I don't understand. I mean, back in 2012, I wrote an FT op-ed and I said, just put a quarantine up. You just stop all the ships in the Gulf of Oman coming out of Kharg Island. Kharg Island's like 5 miles from the coast. We could take it, but then we'd be under constant bombardment from drones and artillery and missiles and things. So, again, I'm not a military guy, but the military guys and gals I know don't really see the need to occupy Kharg Island. We can still choke off Iran's exports. We can do that, but we can do it far away on the water.
Why would this administration want to choke off their exports when they literally took Iran off of their sanctions list, even including in that general license that Americans can now buy Iranian barrels?
Right. So right now, Annmarie, you're right. Right now, the strategy of the administration is put every barrel it can into the market to try and break crude's ascent. Okay, and so that, you're right, liberalizing access to Iranian barrels, to Russian barrels, allowing Iran to export at will while others are constrained. But if we go in and take Kharg Island by force, that strategy will obviously change. I'm just saying you can do it in other ways.
Bob, there is a lot of uncertainty around how significantly oil production has already been disrupted in some sort of significant way that could lead to prolonged shortages. Do you have an assessment of that?
We're starting to work that up. The problem is this is still underway and the damages are TBD. But right now, I think it's 3 to 4 months before the major Saudi Arabia, Kuwait, probably maybe longer for Iraq, Rumelia, that field, that 1 million barrel a day outage there could be much longer term. So if you put a gun to my head right now, it's still underway. I'd say on the order of 2 million barrels a day of crude that could be lost for a long time here. Now that's before we get into any potential damage to above ground facilities. Again, the silver lining so far on this cloud is we haven't seen escalation to destroying the facilities we need to process and export that crude when those fields can be brought back up. That would be disastrous. Abqaiq, Ras Tanura Terminal, Kharg Island itself haven't been physically damaged. So that's the other thing to watch for. If that happens, then all the damage estimates, get increased.
How much has the SPR release to the United States and in Europe, as well as the unsanctioned Iranian and Russian oil, potentially cushioned some of what we're seeing in terms of actual production absolutely destroyed?
Well, from a flow perspective, it's marginal, right? At the most, when all the SPR barrels are flowing from the IEA countries, you're looking at maybe a little more than 2 million barrels a day. The deficit, and there's a lot of math going around out there, but we estimate the deficit to be about crude and products 12 million barrels a day or so. So obviously, from a flow perspective, it's not that significant. It is, however, helping keep WTI down. It is cushioning the market a little bit, but it's a speed bump kind of on the way higher.
Bob, can you translate a headline for me? Just help me understand how important this is or not. This came from the president speaking to the Financial Times. He talked about this a few times now, about these Pakistan-flagged oil tankers that have been allowed through the Strait of Hormuz. Whether that number is 10 or whether it's 20, can you give us some context on that? How big is that number relative to the amount of traffic that would traditionally go through the Strait?
Yeah, John. So, you know what? We haven't even, it's these tankers, we're not even sure they were oil tankers. They had been dry cargo tankers. If each one at max would have been 2 million barrels, 10 million barrels, 2 million barrels. So it's just not that much. I think all of this really is verbal intervention. A term I learned in the 90s working at Tudor and watching the central banks. This is activating this reservoir of hope and confidence in the market that this nightmare is going to go away. And the president knows when he says things like this, we almost have a deal. 10 cargoes went out. It was a gift. We're escorting tankers out. All of this, I think, is mainly intended to try and keep oil prices down. And that doesn't reflect a real return of barrels. At most, on a given day, maybe a half million barrels a day is getting out, but it's quite marginal.
Bob, it's good to see you. Thanks for breaking it down. Bob McNally there of Rapidan Energy Group. It doesn't seem to be working. Crude right now, 115.
No, because we're not up to normal flows, and how many ships are actually getting through, no one really knows, but it is less than a dozen a day. It's about 2 a day, potentially, on average, according to tanker trackers. And to Bob's point there, we don't know what kind of vessel it was. We don't know what the cargo was. We don't know the destination it was. So it really does seem like this is why it's a muted response.
6 years ago, this was the conversation in financial markets. I'm not a doctor, but 6 years later, I'm not a military guy, but. And you've said this a few times on this show, Bramo. It's difficult to get an edge in this story right now. It's really, really hard.
It's fraught with misinformation. It's fraught with a lack of information about the actual production facilities that have been affected or potentially even destroyed. How exactly you're going to get a foothold ahead of someone else at a time of such quick-moving news and, frankly, so much disinformation out there.
Equity futures just about positive so far, up this Monday morning by 0.4%. Let's get you an update on stories worldwide with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. Iran-backed Houthi forces in Yemen have entered the war in the Middle East for the first time. Houthis firing missiles at Israel over the weekend and saying they would continue operations until attacks stop on Iran and its proxy militant groups. A Russian oil tanker has arrived in Cuba. Russia's Interfax news agency saying the ship is carrying around 100,000 tons of oil. President Trump had said he would allow the shipment for humanitarian reasons, saying, quote, they have to survive. And President Trump ordering emergency pay for TSA agents over the weekend, but major U.S. airports are still urging travelers to arrive hours earlier to get through security lines. White House border czar Tom Homan saying ICE agents deployed to airports may remain for a while. That's your Bloomberg brief, John.
Yahara, thank you. Thanks for the update. Up next on the program, avoiding a falling knife.
Things seem to be in a free fall. You don't want to catch a falling knife. You do get concerned that there is an inflation problem that becomes broader down the road. In the meantime, just let the markets go to wherever they're going.
Up next, we'll catch up with Jordan Rochester of Mizuho, live from New York City. You're watching Bloomberg TV. The longest first quarter ever is almost over. Just 2 more sessions. Then we can wrap this thing up. On the month so far, Brent crude up by some 60%, the biggest monthly rally on record. On the stock side of things, energy stocks up by double digits. Refiners on the S&P rallying 24% through the month of March. Check out the equity market right now. Futures a bounce this morning on the S&P up by 0.4%, on the Nasdaq up by 0.3%, small caps up by 0.5%. Bramo, lots of people making up lots of stories about what's happening with multiples. This from Mike Wilson of Morgan Stanley. We think the equity market is less complacent on growth risk than consensus believes. The S&P's forward PE ratio is now compressed by 17%, which is in the range of prior growth scare outcomes in the absence of a recession or the Fed hiking.
Yeah, with Mike Wilson saying we're getting to the end of this washout period and it's really starting to look more attractive. It's the same point that Fidelity was making with the idea of multiples coming under much more pressure, even as earnings actually start to pick up. No one can game out how big of a downward draft this is going to be on a lot of companies, which is why we're watching the ISM Manufacturing Index, in particular prices paid on Wednesday. It might give you the most current, up-to-date view of how much some of the incoming costs are increasing.
Can you get excited about multiples before the earnings cuts have started? That's a question we'll ask throughout this morning. Under surveillance this morning, avoiding a falling knife.
Things seem to be in a free fall. You don't want to catch a falling knife. You do get concerned that there is an inflation problem that becomes broader down the road. Right now, we're still not expecting recession. You have to go well north of $120 a barrel for recession. So in the meantime, just let the markets go to wherever they're going.
So here's the latest this morning. Traders raising bets higher energy costs will lead to a slowdown in growth. Global bond yields falling with the US dollar headed for its biggest monthly gain since 2024. Jordan Rochester of Mizuho writing, when it comes to understanding where we will trade, think less about taco and more about nacho, not actually changing Hormuz opening. Jordan joins us now for more. Jordan, welcome to the program. With that in mind, inflation versus growth, do you put more weight on one versus the other?
John, good morning. I think inflation is the most important thing. It depends which central bank you're talking about, though. There is, of course, the dual mandate for the Fed, where economists can definitely debate about the growth impact in the US because the labor markets tend to be much more important than the inflation target. But that is just not the case in Europe, with the ECB's explicit mandate being the target for CPI, the Bank of England as well. So, John, it depends which central bank you're talking about. But in Europe, I think it's quite clear the trades will be that the central banks respond to this by demand destruction. The rate hikes that are being priced in by the market will need to be delivered, John, if we stay at these levels of oil, because you will see second round effects of inflation. Where in the US, you've got the energy independence. You've also got a smaller rise in energy prices. Natural gas prices have barely moved in the US. Therefore, electricity won't be responding in the same way that Europe will. And therefore, you have to really talk about the difference between the two.
Jordan, let's talk about the US side of things. I hear a similar story. We all do repeatedly on this program. Just a bit of pushback. The idea being the US economy is in a stronger place, that the labour market might be somewhat tighter than would otherwise be known by looking at the payrolls numbers every single month, and the fact that the fiscal story is front and centre too. We're getting tax refunds just as these higher oil prices are hitting. Do you think we're underestimating the potential for second-order effects?
I think so, John. I think never underestimate the potential for the US to bounce back as well. It's a very resilient economy. You had my colleague, Stephen Rasciuto, on the program just last week, I believe, talking about how he doesn't expect any Fed cuts this year. And that was before the war even started. So I think, John, the sort of risk here is that we start to price in rate hikes more aggressively for the US than what's being given credit for. But just think about the second round effects of inflation here. So a lot of economists talk about this being an oil shock, and they kind of forget that it's also about polyester. It's also about fertilizers. It's also about everything to do with helium. And this will feed through to many different parts. That's clothing going up. That's your sort of plastics, your consumer products also responding. And then, of course, food. And the other point as well that economists are leaning on, because they don't really want to consider the other option, which is this is going to be a quick war. Well, what if it's not, John? What if we're here in June? What if we're in July? Talking about the same thing? I think what will have happened by that point is you'll have a new Fed chair and he just won't be able to deliver the Fed cuts that the president hopes that he will. And the rest of the FOMC might be talking about the idea of maybe we have to raise rates.
Jordan, is 2022 a good point of reference when thinking about this moment?
I think it is for trading it. I think it's a playbook that investors can lean heavily on. In fact, if you look at how the currency market is moving, it's following, and the credit market as well in terms of credit spreads, it's following the 2022 movement in price action to the letter. It's quite spooky, really. Scooby-Doo needs to be given a Scooby snack for spotting it. But when it comes to economists, they will tell you it's very, very different. They'll talk about how fiscal policy is not as loose as it was. They'll talk about how job vacancies are nowhere near as high as they were. All these factors, and the fact that inflation and supply chains in China are nowhere near as high as in terms of restrictions that we had at the time in 2022, nowhere near the same. That's absolutely right. But I think that if you just look at the experience of the sort of 1970s and 80s, we've had an inflation shock already. We've now got consumers whose inflation expectations are much more elevated and volatile than they used to be. And we've got employers and firms willing to raise wages and prices much more than we were used to in the period of the Great Moderation. So this is a very, very precarious time for central banks to lean on the idea of this being transitory, because if you have a few months of this where clothing prices, food prices, plastics, etc., not just energy, are all going up at the same time, that to me smells of second-round effects.
So, Jordan, how much upside do you see for the dollar versus the euro versus everything based on that kind of trading playbook?
Well, that playbook got euro dollar down to parity back in 2022. It was extreme. It was a very euro-focused story, with the US benefiting from the LNG exports and oil exports and picking up the slack from Russia's supply being constrained to Europe. We're following the same path of euro dollar's depreciation and the dollar's appreciation as 2022, but it's all about how long this war lasts. So if you make the assumptions over by the end of this month, then sure, euro dollar heads back higher. We're at 116 to 118, 120, who knows? But if you make the assumption that the strait remains closed and we get to July, we get to September, I really don't want to talk about it, but let's say December, then below 110, 105 parity levels, each month this goes on, we're going to have to lower our forecast for it. So the way I see the dollar appreciating right now is I think we'll get euro dollar down to 112. We talk about 110 if we get there July and onwards. But it's in terms of trade shock, the rate hikes that have been priced into the ECB and the Bank of England, it's helped buffer the sort of dollar strength that you would have usually seen. But we've now had so much priced in for both of those central banks. It's hard for the interest rate story to overwhelm the terms of trade shock that's feeding through.
Jordan Rochester, go away. It's good to see you. Thank you, sir. Jordan Rochester of Mizuho. December. Can you imagine if this went to December?
If it goes to December, I wonder if this idea of a petro-yuan actually comes and takes shape. Meaning, if you have to pay a toll in Iran, it's going to be in yuan, and China will be an ultimate beneficiary of that.
Well, right now, nobody is thinking that that's a possibility based on where the futures curve is, given the fact that right now we're looking at $76 a barrel in December. So this isn't exactly a priced-in scenario. A lot of things would have to get repriced, not just the euro.
If it started going on that long, to Annmarie's point, things start to change.
Structural shifts.
Yeah, and things start to become formalised, whether you like it or not. And that's Iran ultimately offering a toll. And if you've got a certain flag on a certain ship, you get through, and if you don't, you don't.
Well, over the weekend, we heard from one Iranian official saying we will never go back to normal. We are determined now to make sure that we get a fee for this strait. And I think for the United States, that's very unnerving, because this is an international waterway, not to mention Oman and UAE, which are part of that as well.
Futures right now positive by 0.4% on the S&P 500. Up next, a man who raised his price target on the S&P 500. We'll speak to Krishna of Barclays in just a moment, plus Henrietta Treyz of Veda Partners, Clayton Seigle of CSIS, and Al-Hussainy of Columbia Threadneedle. The second hour of Bloomberg Surveillance just around the corner.
It's premature to talk about a Fed easing because the oil hit takes down growth.
The Fed hiking is not going to get oil to flow more freely. They are going to sit this out.
I see no indications that this is going to go away anytime soon.
You still don't see the potential for rate hikes on the horizon.
The U.S. economy can take a few more punches than the rest of the world.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your price action, the scores look like this. Equity futures on the S&P bouncing by just a few tenths of 1%. We're up by 0.5 following the biggest two-day loss on the S&P since April of last year, down almost 9% from the highs earlier this year. In the bond market, are we beginning to price in lower growth, slower growth? Yields down by 4 basis points on 2s, down by 4 on 10s, 4.39. With this in mind, crude just holding on to these levels, triple digits on WTI, triple digits on Brent crude, 115, and up by more than 2% this morning.
Yeah, it is an incredibly difficult market to get your head around, given the fact that you potentially have an inflationary shock. You're seeing earnings hold in and actually increase. In other words, in the U.S., the consumer is still strong, and yet we don't know the second-order effects. You're starting to hear about them on the margins. Right now, at least if you listen to the likes of Goldman Sachs, JP Morgan, TD Securities, and many others, it is a time to buy bonds because ultimately we have overpriced the inflationary shock long term. Question is, what gives anyone certainty of exactly where we are at such quickly moving news as well as markets?
It's another Monday morning confronting escalation risks. Several stories over the weekend, just unnerving, rattling some investors. This from the Washington Post, the Pentagon preparing for weeks of ground operations in Iran. I believe the Journal discussing a special ground operation, maybe Kharg Island. The president gave a nod to that over the weekend. This is where things get even harder.
It does get even harder because while there were discussions over the weekend in Islamabad with a number of countries that want to act as mediaries to try to bring this to a halt, and the president said maybe there'd be a deal, the Iranians saying no. And they were even saying they weren't really represented in these discussions. And then you have all of these reports. Wall Street Journal talking about potentially a special force to go in and seize the uranium. Washington Post talking about maybe more troops on the ground. And at the same time, the president to the Financial Times saying, I want to take the oil, which would maybe be going through Kharg Island, where 9 out of 10 every Iranian barrels goes through.
Multiples have compressed. We've had a decent correction on the NASDAQ 100. Other stocks, single names, some big moves on the likes of Microsoft and Meta. That's been building now for months. This from Stuart Kaiser. Do you want to buy the dip? We are not dip buyers yet. Negotiations show no visible progress, and next escalation steps are very worrying.
We have no idea of the downside risk. Potentially, the sky's the limit when it comes to some of these oil prices. We've heard $200 thrown around. We're hearing about physical shortages in Asia. You can come up with a really gloom and doom scenario. The knee-jerk reaction on Wall Street to look through geopolitical risk has not worked for the past 5 weeks. At what point do we have a sense that you can go back to that buy the dip moment, given the fact that we do not see a pathway out of this?
Brent crude at 115, high this morning by a little more than 2%. Coming up this hour, we'll catch up with Krishna of Barclays as crude climbs higher, Clayton Seigle of CSIS as the Middle East war widens, and Al-Hussainy of Columbia Threadneedle as markets price in lower growth. We begin this app with stocks pairing losses as crude hovers near 115. Krishna of Barclays raising his 26 S&P target to 76.50, writing, we are incrementally bullish on US equities. The macro regime has turned messier but not hostile. Venu joins us now for more. Venu, good morning.
Good morning.
This is a really interesting note that you put out, and thanks for making some time for us this morning. What a moment to raise your price target on the S&P 500. Where's that confidence coming from?
You know, every year we assess our numbers towards the end of the first quarter, when you have the full year, the previous year behind us, the fourth quarter earnings momentum. And that was a process. So while I fully recognize that the macro environment has become more fragile, but we are approaching it from a fundamental perspective. And the news over there is that earnings momentum has actually improved quite significantly. And we ended last year in a much better position than even what we thought. Earnings growth of over 14%. And this year we're expecting that to accelerate 15-16%. Of course, the caveat is that the base case is that this war, which has come out of the blue, does get resolved in the next few months. If that goes out of the window, clearly we have a downside case where S&P we see going down to 5,900.
Messy and not hostile. A few months separates one versus the other. So if we're 2 months into this and these price moves continue, even then you'd be bullish on this market. That's curious. I'm interested by that you wouldn't take down your earnings expectations even if we got another month, 6 weeks of this.
Not yet, right? At least we would wait for this quarter's guidance to come through. Let's see what companies are saying. Everything we're seeing on the ground is that the momentum is significantly to the right rather than the left. But I do recognize, like I said, that the left tail risk has become much fatter, mainly because of this one event risk. But while we can brush aside that, that the market is looking past geopolitical risk, and we have pointed that out, the reality is in the last decade, every geopolitical risk event has been resolved in a reasonably decent time frame, and it has been contained. Now, the risk right now is that it is not contained in the Middle East. It's gone to Saudi Arabia, UAE, Kuwait, Bahrain, Oman. So I think that risk is real right now. But again, the core belief is that we're already in the early stages of negotiations, right? Obviously, the two sides are wide apart. And the single biggest threat to the global markets right now is the control of the Strait of Hormuz, right? And we have to figure out how that gets resolved. There has to be a give and take on both sides. One side is extremely weak, has its back against the wall, but they have a trump card in the Strait of Hormuz.
There are a lot of people who would agree with you, including Mike Wilson over at Morgan Stanley. There is, though, a shift in the dynamic when it comes to inflation and the rate backdrop when you talk about the oil price shock. If you do have companies that are continuing to raise their earnings expectations on the heels of a strong consumer, don't multiples get compressed just by virtue of the fact that rates have to be a whole lot higher?
Multiples have already compressed quite significantly. I mean, I give you the example. S&P is trading below 20 right now. Right? If you look at big tech, we were trading at 31 times last year, beginning of last year, ended last year at 28. Now we're at 23 and change. Same thing with the rest of technology sector. So multiples have already adjusted primarily to factor in what you're saying about the uncertainty about how this plays out. It's the earnings which have not, and they will react, in all fairness, if things go really bad. But we're not there yet. We're not seeing that yet.
I guess another way to ask the same thing is, are we underpricing the risk of true inflation that has a prolonged presence in the system if the economy is that much more resilient than people currently are expecting?
You know, inflation risk is already being priced by the rates market. That's why you're seeing the yield curve flatten quite significantly. The front end is up. You know, so I think we take a step back and say, what if, to your point, if oil stays, let's say, 100 or above for an extended period of time? And then it's a mixed bag in the sense that there are certain sectors that actually benefit. Clearly, energy, materials, partly industrials are able to pass on price. But the single biggest negatively impacted area is the consumer-facing segments, staples and discretionary. So I think it all boils down to how bad the situation gets, how long it persists, and that will tell you what the implication on inflation is. It's not just inflation. We are not factoring the impact of growth as yet. So in the worst case, it's not just inflation, it's growth. It means your curve can actually get inverted. And we are looking at the 5,900 situation. So what I would say, the tail has become fatter, the probability has increased, but still, if you look at our base and upside case, that is still our dominant view that this will get resolved.
Your bear case, what would oil have to be to get there?
We are factoring in roughly $100 of oil. And that
Why do you
seems
think it's not going to be $100 in the next few months? There's a lot of
it's
structural
already
changes.
there. It's already there.
Yeah.
Our view is that this is not going to be sustained. If you look at the forward oil curve, that's telling you that this is not sustained. If I look at our own oil analysts, they also expect things to be lower down the line, right? We're talking about 6 to 9 months. So I think therein lies a risk in the sense that the market and the analysts, experts in the area, are factoring in some sort of a resolution. But listen, all bets are off if you're talking about 150 or higher oil price for a sustained period of time. That is the single biggest unknown. And unfortunately, I would say nobody, absolutely nobody has a clue as how this plays out.
This is the Middle East. That's that story dealt with. Let's look through that. You're looking through that. There's more to this market than just the Middle East right now. And a lot of the problems in this market predate the start of this war, particularly in tech. Microsoft has lost 30% of its value since the highs of late last year. The Nasdaq's down by 10%. Meta last week got hammered, down 11%. That had absolutely nothing to do with what's happening in the Middle East. Can I get your reflections on that? What's the driving force behind big tech, and where does the leadership come from?
Sure. So I think big tech is one of the most interesting conundrums right now, in the sense that on their earnings front, it's extremely robust. Even in fourth quarter, by the way, over 28%. So, and the rest of tech, outside that, over 22%. So that is a tremendous number. What's happening is the market is clearly focusing on the scale of capital spending. If I looked at our own numbers on what we thought the hyperscalers are going to spend, in December, we expected them to spend $550 billion in 26. Now we're seeing about $715 billion, right? So we're talking about 30-40% increase in capital spending. The biggest uncertainty now is how long are they going to keep spending? Our internet analysts believe that the peak is going to be in 28 and significantly higher than where the market is, right? right? And I think that is where the problem is. The free cash flow yield has come down. The tech companies are insisting it's an investment in a transformative technology which is going to change the world. The market is a little wary as to how long this is going to happen and is it going to be a permanently capital intensive business. And that's why as the free cash flow yield has come down, the multiples are adjusting from 31 to 28 to 23 right now. And that's the reason why we actually like that area, to the extent that the rate of earnings growth is significantly faster than the rate at which the multiple is compressing. You will have solid returns. You saw that last year. They, as a group, big tech, returned 23%. S&P returned 18%.
Does it make sense to you that you potentially have a sell-off in these names for investing too much and a sell-off in names that are all going to get disrupted by all the cool things that they create with all of this money?
That is inconsistency, right? How can you have both at the same time? On one hand, you're saying this is the biggest technology and this is most transformative and the whole world is going to benefit, but they're then penalizing them. I think it's the disruption risk. Nobody knows who within software is going to survive, whether it's SaaS, whether it's security, which models in AI are going to happen. You can certainly expect some massive capital misallocation as well, but they're going to be huge winners and losers. I think it's not clear right now who they are. And we will stay in this limbo. But I like the setup where if your core earnings are still strong and your multiple is coming down, you're effectively now at a PEG ratio, which is less than 1. I love it.
The key call here, though, is you think the CapEx ramp-up continues, even as the market pushes back.
Yes.
That's quite a big call.
The CapEx will continue because, one, we are still in the sort of early to mid stages of this technology's development. Two, these companies have very robust profitability. By the way, in fourth quarter, their overall profitability increased by 150 basis points on 28% plus growth. They are borrowing money from the credit markets. It's minuscule compared to the overall capital structure. It is multiple times oversubscribed and trading significantly tighter than where the IG index is even now. So I think the capital is there. They'll continue to spend because they're scared to be left behind. And therein lies some of the risk of capital misallocation between them. But we have no doubt that this is the future. And you'll see some big IPOs also this year. And we'll see where the dust settles. We like the setup.
The chip makers hope you're right. Let's put it that way. Vena, it's good to see you. Thank you, sir. Krishna there of Barclays with a new call on this equity market, getting more bullish as the weeks go by.
I feel like we should have a new slogan for 2026. Nobody knows nothing, because ultimately we don't understand the parameters, and so everyone's trying to figure out what puzzle they can solve and then say, well, all bets are off if we're wrong on the parameters.
I said last week when the note came out, by the way, I appreciate the boldness.
I love it.
I really do. When people are just sat there paralysed and don't know what to say, I appreciate the conviction.
It's good scenario analysis, fat tails, sure, but scenario analysis nonetheless that shows the strong position of a lot of companies. 76.50, almost consensus just several months ago, and now very, very bullish.
Yeah, I mean, earlier we were considered to be on the low end. Right? And all we did was, by the way, this was in the works. I didn't raise it that particular day.
Yeah.
We had the numbers a week before. When we went to 321, we were $4 or $5 ahead of consensus. The first time in 5 years I was ever ahead of consensus. Now consensus is ahead of me. It's 323 from 307. So that trajectory is crazy. And by the way, I think interesting thing to note, I forgot to mention, is that for the first time in a long, long time, by this time, typically consensus goes down 150 basis points. Now we're up 400 basis points. That's a 550 basis point delta, right? How do you explain that?
Vena, it's good to see you. Thanks for being here. Appreciate it, buddy. Stocks up by 0.5% on the S&P with an update on stories worldwide with your Bloomberg brief. Yahira has more. Hey, Yahira.
Hi, John. President Donald Trump says he's ready to make a deal with Iran. Speaking to reporters on Air Force One, the president saying Iran is giving the U.S. most of the demands from its 15-point peace plan. Iran still disputing Trump's claims about negotiations. An Iranian missile strike on a base in Saudi Arabia, damaging several military jets and destroyed a valuable E-3 jet. Sources telling us here at Bloomberg the $300 million plane was hit in an attack on Prince Sultan Air Base in recent days. And the Spanish government announcing it's closing the country's airspace and bases to U.S. planes carrying out missions in Iran. Spanish newspaper El País reporting that the country is only allowing the transit or landing of planes in cases of emergency. That's your Bloomberg Brief. John?
Yahira, thank you. Thank you for the update. Up next on the program, navigating negotiations.
They're being hit so hard, anybody would be negotiating. They are negotiating. They're begging to make a deal. They have to open it up. They have to open up the Strait of Hormuz.
Up next, we'll catch up with Henrietta Treyz of Veda Partners, live from New York City this morning. Good morning. The worst week on the S&P 500 since October. On the Nasdaq 100, the worst week since April of last year. That's just last week. This is the bounce this morning, up by 0.5% on the S&P. On the Nasdaq, up by 0.5% also. In the bond market, yields down across the curve. We're down by about 5 basis points on the 10-year this morning, 4.38, with crude still higher, just short of 115 right now on Brent crude.
Yeah, people looking at this as potentially a growth shock if it goes on for a long period of time. We've heard from a number of different executives, including the airlines, that should this continue, they're going to increase prices and they're expecting some kind of consumer demand pushback. That said, we don't have a sense of that. So it's basically people throwing darts at a dartboard to understand what the parameters of this conflict are.
Another Monday morning of doing just that, with Brent crude at 114.60. Under surveillance this morning, navigating negotiations.
They're being hit so hard, anybody would be negotiating. They are negotiating. They're begging to make a deal. They have to open it up. They have to open up the Strait of Hormuz. When this war ends, it's going to be like a rocket ship. I thought oil prices were going to go up higher than they are now. I thought that we would see a bigger drop in stock. Hasn't been that bad.
So here's the latest this morning. The war in the Middle East at its 5th week with no end in sight. Annmarie, this is the escalation over the weekend. Iran-backed Houthi militants entering the conflict. At the same time, more U.S. troops arrive in the region.
A lot of individuals in the energy world, they were saying that this would be a serious escalation and a serious risk for oil prices. How much higher could they go if you then introduce another choke point that basically gets cut off? And that's the Red Sea, that's the Bab el-Mandeb Strait. We saw that in 2023. Do you remember all those ships started to avoid the Red Sea because of the Houthis? We could be in a place like that once again. And we should remind everyone, even though U.S. Maritime and you had the UK Navy was there, the British Navy was there as well, it took minimum 6 months for a lot of these ships to agree to even touch the Red Sea once again and go back through there. So this potentially could be a massive risk, not just when it comes to maritime safety, but also energy prices.
In some ways, it's surprising that crude's not higher than it is this morning. The paper market, once again, speaking to the disconnect that so many people are talking about between physical and what's happening in financial markets.
We don't really have a sense of exactly how much physical damage has been done and how long it's going to take to restart some of the production facilities. Also unclear exactly how much of a Band-Aid some of the SPR releases, as well as the Iranian and Russian crude that's been on sanction, has really been to cap some of those prices.
This is the take from Henrietta Treyz of Veda Partners. She writes the following: there remains no end in sight to the war, and ceasefire negotiations are leagues away from reaching an agreement. Henrietta joins us now for more. Henrietta, welcome to the programme. How much support is there for this operation on Capitol Hill?
No, I think that's the perfect question when you're trying to put parameters around the realm of the possible here. Lawmakers are gone. They went on recess. They'll be gone until mid-April. And at that point, they still have to deal with a whole host of other issues, from the Warsh nomination to reopening DHS, which is on day 45 or whatever of a government shutdown. The disconnect that I see most prominently is that the market is focused on the war so intently, on oil and gas prices, on the impact to inflation, and lawmakers are gone. So when you talk to members, it's plain that the president has absolutely no pushback politically from his conference, or no meaningful pushback that's organized from the Democratic conference to force a political end. And I'm just trying to suss out from staff and members where their pain points are. And it's really $5 gasoline. It's not $4 anymore. So we're at $3.99, I think, right now.
Yep.
It's not the $4 point that's the inflection metric. It's $5 post the Arab Spring and post pandemic. And really, they have the latitude that they need to perpetuate this war into June, based on my conversations.
Henrietta, it is shocking but not surprising that lawmakers decided to go on their break. Meanwhile, they've caused havoc in terms of TSA agents not getting paid. And on top of that, we are in the middle of a war. And there's a $200 billion request from the administration for Congress to take up. Where does that stand?
I think those are really strong indicators that we are going to perpetuate this war first and foremost. Never mind the fact that thousands of Marines have now landed and are in the region ready to be deployed at the president's direction. But the president and Secretary of Defense Hegseth have requested $200 billion. Over the last maybe 5 or 6 days, you've seen the Budget Committee chairman spring into action. Lindsey Graham on the Senate side and Jody Arrington on the House side saying, we're going to get you reconciliation. On April 3rd, the White House will lay out its budget request. That will kickstart the process, and then Republicans will be off to the races to give the president whatever he needs on both the military side, but also on domestic discretionary spending, consumer fiscal spend, stimulus to get the American public through the war for as long as it will take. So in my experience, we don't pass reconciliation bills that are less than $700 billion.
Well, what kind of fiscal stimulus could
Sorry,
they
say
do?
it again?
What kind of fiscal stimulus is Congress able to do?
There's a couple different things that they could do. The first would be suspend the federal gas tax. That's going to be an 18.4% reduction or cent reduction in the gasoline price, 24.4 on the diesel side. Those are immediate term actions that Congress could do via the tax code that would work under reconciliation. And the rest is going to be on the spend side, from $200 billion to defense, money for Venezuela, money for Pell Grants for farmers. There's going to need to be another $15 billion bailout. And then they could see if they want to extend or expand any of the One Big Beautiful Bill tax cuts. Those benefits that they passed in July of last year have been wiped out per the Bloomberg analysis. After $83 a barrel, you've wiped out the whole stimulus from the One Big Beautiful Bill. So we're well past that.
Henrietta, always good to catch up and great to hear from you. Henrietta Treyz there of Veda Partners. There is a dangerous military conflict undergoing in the Middle East right now. The president at the moment is conducting a lot of this. The support, though, has come from a senator in South Carolina. The airports are a mess in this country, and the senator from South Carolina has been seen at Disney World.
Yes, that's what TMZ, and they have photos of him saying basically had a great convo with Mickey Mouse, and he was at one of these character breakfasts. I guess he's on vacation in Disney World, and there is going to be a tremendous amount of pushback on all of them for leaving town at this time right now. Again, it is shocking, but it's not surprising.
The optics of that are just absolutely horrendous, aren't they?
The optics of people leaving Washington, D.C. to go on vacation while TSA agents are not being paid and people are waiting on 3-4 hour lines to go on their vacations doesn't scream of competency on any level. What we were just hearing from Henrietta Treyz there, the only thing that they can pass is a reconciliation bill with more money to be spent to try to pay off people to make them feel a little bit better for some of the circumstances that have transpired. It is incredibly difficult to see how popularity of this Congress could get any worse.
I know, we talked about this just last week. I wish they'd stop seeing this as Democrats versus Republicans. This is not about Democrats versus Republicans. This is about Congress doing their job to help this country function.
And to build on that, how much does this hurt both parties significantly and make both parties more radical, frankly? Because everyone on either side is going to say, I want someone to go in there and rip the Band-Aid off and make a change. And usually that comes with more radical policies, which is pressuring both sides to the polls.
Sometimes it's nice just to talk about markets, isn't it?
I completely agree.
Equity futures positive by 0.6%. Up next on the programme, we'll catch up with Clayton Seigle of CSIS as Brent crude heads for a record month of gains. From New York City, you're watching Bloomberg TV. A statement from the president just moments ago. Allow me to read through it. It dropped just minutes ago. The United States of America is in serious discussions with a new and more reasonable regime to end our military operations in Iran. The president going on to say great progress has been made, but if for any reason a deal is not shortly reached, which it probably will be, and for any reason it won't be, If the Hormuz Strait is not immediately open for business, we will conclude our lovely stay in Iran by blowing up and completely obliterating all of their electric generating plants, oil wells and Kharg Island, and in brackets, possibly all desalination plants, which we have purposely not yet touched. This will be in the retribution for our many soldiers and others that Iran has butchered and killed over the old regime's 40-year reign of terror. That from the president just moments ago.
He's clearly negotiating at the moment, negotiating out loud. He's talking about maybe, like he said yesterday to reporters on Air Force One, maybe there is going to be a potential deal. He also was talking about the fact that he is dealing with a, quote, more reasonable regime. I think it's important to remember the regime hasn't changed. It is still intact. It was just new individuals that are now rising to the top. Does the president think he can really deal with the foreign minister, who his team dealt with on the last go-around, and the Speaker of the Parliament, Mohammed Ghalibaf, who he mentioned as well in the Financial Times? I think that remains to be seen, because right now Iran says they are not open to this negotiation.
If you're in this market, what do you do with that statement? Equity futures briefly at a new session highs up by 0.7% on the S&P. Does that move this story forward at all?
If you believe that there truly are negotiations and a deal will probably be reached, maybe you could see this as bullish. If you feel like this is potentially leverage increasing at a time where it's unclear exactly what the nodes of leverage actually are, it leads to even greater escalation risk if you start attacking some of the key infrastructure for civilians. So you could take it either way. Question that I have is, why is this market really trading on the idea that the deal will probably be reached, according to the latest post from President Trump?
So let's roll through the boards. Let's start with equities. We'll start with equity futures. We'll turn to bonds and finish on crude. Equity futures near session highs up by 0.6% off the back of this. On the Russell up by 0.7. Yields near session lows down by about 6 basis points on a 10-year, 4.37. And in the commodity market, crude higher by a little more than 2%, holding on to those levels at 115. So crude has barely moved off the back of this statement from the president just moments ago.
Crude is looking at the physical market, they're looking at the actual destruction, and they're looking at a very different calculus than some of the other markets. It seems like the taco trade is still what everybody wants to lean on. People want to essentially go back and buy the dip. Just really, I'm not sure where this leaves us, given the fact that this does also, if you take him at its word, increase the risk of escalation.
At the same time, to this point, the oil market potentially is, this is the boy that cried wolf. How many times have we heard this president say, if you don't open up the Strait of Hormuz, I will do this, and then he kicks the can down the road, and we have a new deadline and new threats. Earlier this morning, before the president's Truth Social, Iran's foreign ministry had this to say. They said the U.S. demands for the end of the war are, quote, excessive and illogical. They also went on to say we had never had any direct negotiation with the United States, which has been raised. Our messages received through intermediaries, indicating the U.S.'s desire to negotiate. It does not sound like the Iranians want to participate at this moment with having that engagement with the United States to potentially have an off-ramp from this war.
Equities up by 0.6%. Let's get you some single names, some morning movers. Danny has more. Hey, Danny.
Hey, John. Starting with the aluminum companies this morning after seeing some attacks on aluminum production facilities in the Middle East by Iran. Both Alcoa and Century Aluminum have actually been down since the start of the war, but with new threats of supply constraints as the price of aluminum itself moves higher, these stocks are up by more than 9% this morning. Elsewhere, a little bit of sell-side action. Jefferies upgrading both Expedia and Instacart, saying that the internet names that have sold off with the AI fears have been overdone, specifically pointing out companies like Expedia saying they're going to benefit from AI. They're adopting more tools. It's a buy at this moment, considering how much it sold off. Those shares up 2.3%. Finally, a little bit of deal news. Cisco, one of the largest distributors of food goods to restaurants, hospitals, various businesses, is buying in a $29 billion deal. Restaurant Depot, they're a cash and carry business for distributing foods and supplies to restaurants. Cisco, it's the acquirer. You tend to see them fall because of digestion of such a big deal. Those shares off 4.7% in the pre-market, John.
Hey, Danny, thanks for the update. More from Danny in the next hour. On our radar this morning, President Donald Trump considering a high-stakes military operation to seize nearly 1,000 pounds of uranium from Iran. The Wall Street Journal reporting the plan would involve putting U.S. troops inside the country. Elsewhere, the Senate Banking Committee is planning to hold a confirmation hearing for Federal Reserve Chair nominee Kevin Warsh. Punchbowl reporting it could take place the week of April 13th. And finally, TSA agents set to receive paychecks today following President Trump's emergency order. Agents working without pay since DHS funding lapsed in February. Airports still urging travelers to arrive hours early to get through security lines. And that is your radar this morning. This is our top story from the president just moments ago. The US of A is in serious discussions with a new and more reasonable regime to end our military operations in Iran. The president saying we're making so-called great progress. But if we don't make progress, if we can't make a deal to open the Strait of Hormuz, in this statement from the president this morning is a long list of threats.
Yep, a long list of threats of what they plan to potentially go after. Desalination plants, some energy facilities across the country. Another threat from the president to want Iranians to open up the Strait of Hormuz. Even if the Iranians were willing to open up the Strait of Hormuz today, and remember, it technically is open, it is just controlled, a new precedent has been set. The Iranians have basically said it is never going back to normal, and we will continue now to collect fees. There is now a Tehran toll. In order to pass go, in order to get your cargo through, you are going to have to pay this regime a lot of money. And that seems to be the direction of travel when it comes to what is going on in what is an international body of water.
This is the escalation threat that's lingered over this market now for more than a week. This is the threat that they will go even further, obliterate their electric generating plants, oil wells in Kharg Island, and possibly desalination plants. Now, that would be hugely controversial because that would hit civilians, and you'd have to worry about retaliation across the region as well, which I imagine makes Gulf partners very nervous at the same time.
We could already feel that, and they've already communicated that. Desalination plants, this could turn into a war over water, which is more severe than a war over oil, and that is clearly what a lot of people are concerned about. When you take a step back, you look at whether President Trump can solve this quickly, right? I mean, I'm just going back to the way that the market is sort of breathing a sigh of relief on this, given the fact that maybe this brings some sort of finish to this. It's hard for the physical market to see that sort of progress, given the fact that this is a very different set of circumstances. And it's hard to know who you're dealing with. I mean, can you de-escalate by escalating, given some of the parties involved?
Joining us now to discuss is Clayton Seigle of CSIS. Clayton, welcome to the programme. I'm sure you've heard the statement from the president out just moments ago. What's your reaction to it? How are we meant to read into that particular statement from the president?
Hey, good morning, Jonathan. I would say today's messaging is rather escalatory. And I think, as you pointed out, there's really two big concerns here. Number one, we're supposed to be coming ostensibly to the rescue of the Iranian people and trying to loosen the shackles of this oppressive regime. So by destroying Kharg Island, by destroying desalination facilities and other critical infrastructure, this would really be doing the people of Iran a terrible disservice once this regime is gone and out of the way. And the second thing, as you pointed out, is the risk of much more severe retaliation than we've seen so far against the Gulf countries that neighbor Iran, and even against other critical infrastructure and supplies. I guess I'm not surprised to see the president looking for ways to lever up against Iran, because this new control over the Strait of Hormuz and the Mideast Gulf generally is, as you guys have said this morning, kind of the new normal. And it doesn't look like Iran is liable to cede that new leverage anytime soon. It's going to stick with it. It's going to leverage it in negotiations with all kinds of counterparties. And so no surprise that in Washington they're looking for ways to maybe level the playing field and get an edge if there are going to be meaningful negotiations.
Clayton, to that point, this is a signal that a lot of people are taking, that Washington is looking for a way in to a true negotiation that can bring a sooner end to this. Do you see any way for the United States to get an angle to expedite some of those negotiations?
I think that the path to negotiations is open. It's either they're already taking place, as the president has asserted several times recently, or I think that door probably is open, even with the people that are running the regime in Iran, who are, by all indications, more hardline than the previous group that was in control before the wave of assassinations. With that said, yeah, the door is always open to some kind of negotiations, but the question in any market is whether the two sides can come together. You know, what's really the gap between the two. It looks kind of unbridgeable right now, but you never know until the sides get to real talking. So I think that the diplomatic process is where this is eventually going to go. And what markets are trying to price is how much carnage to supply chains and how much of a cascading effect through the macroeconomy is likely before we get there.
Do you think that the market is still underpricing just how high oil prices are going to remain, not necessarily now, but in 6 months, 9 months, and 12 months' time?
I do. I believe that the paper markets, futures, et cetera, are a little bit sanguine, I would say, to use the fancy terms. It looks like they are still expecting a relatively soon resolution, early resolution to the crisis that would resolve this big supply disruption. But we're going to be contending with a supply disruption even if everything ends today. And so depending on the math you use for how much Saudi Arabia and United Arab Emirates have been able to bypass the strait and get some oil out through the Gulf area, and maybe how much is coming just in a trickle from Iran, you're still looking at a disruption that's been somewhere around, on the low end, 10 million barrels per day for the past month, 3 or 4 weeks. So 200, 300 million barrels is going to be missing from global supply-demand balances going forward. It's going to hit, first of all, in those markets in Asia, and then it's likely to proliferate throughout buying regions in the world. That's got to eventually be reflected in higher prices, which, as y'all have pointed out this morning, have already been manifest in the physical market, what people are really paying for and selling for wet barrels of oil. It just hasn't translated into the futures market because a lot of traders, maybe non-commercials, are expecting an early resolution.
Clayton, how much of a direct threat are Saudi Arabian barrels in the Red Sea right now?
Well, they're under greater threat this morning than they were this time last week because the Houthi militia in Yemen has joined the war. It started in a relatively modest way by firing, I think, a couple, 3 missiles in the direction of Israel, which were intercepted. But the big threat here to oil markets and to the macroeconomy generally is that the west coast of Saudi Arabia, along the Red Sea, where some oil exports have been able to be diverted and still get to market, that could even be in jeopardy if the Houthis get back to their old tricks, which was disrupting commercial shipping in a big way in the Red Sea after November of 2023. So that's the big risk there, is that last kind of escape hatch for at least a limited amount of oil going to world markets could be in jeopardy.
What kind of impact on prices would that mean if we have both these two choke points basically closed?
Well, you would lose another, let's say, 4-ish million barrels per day that's been able to make it to market up until now. And then you'd get the Gulf exports really back to almost the full disruption of, say, 15 million barrels a day of crude, another 5-ish of refined products. Prices have to move higher in that case. And I feel like a lot of folks are maybe downplaying the extent to which prices would have to increase in order to balance the market. If you just had to take like 8 million barrels a day of demand off, then you're looking at basically like COVID era 2020 type reductions in use of fuel and other oil derivatives. And so you're really looking at kind of a massive slowdown in economic output.
That is
so
massive
that's
demand destruction.
the market's last mechanism to balance when you get to those high prices.
Hey, Clayton, it's good to hear from you. Thanks for making time for us. Clayton Seigle there of CSIS. We've said it repeatedly over the last week. Two-way risk. This can go one way or the other, and they are in very different directions if we go in either. The United States of America is in serious discussions with a new and more reasonable regime. Great progress has been made. Then there's a major but. If for any reason a deal is not shortly reached, we will obliterate all of their electric generating plants, oil wells and Kharg Island, and possibly desalination plants.
The reason why this is concerning to the likes of Clayton is that in the past, Iran's response to this is, you strike us, we strike other regional countries that much harder, and we will attack their civilian infrastructure. That is the red line for Saudi Arabia and UAE, and the reason why this could escalate into something much larger.
And those countries have already seen this when it comes to energy facilities, when it comes to civilian infrastructure. Look at what's going on in some of these aluminum smelters, which immediately moved the market prices. But the president this morning is at least verbally escalating in attempt to de-escalate. Come to the table or this will happen. I think the market is just trying to really digest how serious he is in this moment, or potentially would he give the Iranians a little bit more time down the road.
Brent crude, 115, WTI. 101. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Yahira has more. Hey, Yahira.
Hi, John. As you all were discussing, President Trump with a new statement on the status of talks with Iran, writing that the U.S. has seen great progress in discussions with a new, more reasonable regime, but threatening to destroy Iran's key energy sites if a deal is not shortly reached to reopen the Strait of Hormuz. China's Xiaomi delivering more than 4,000 of its new SU7 electric sedans in its first week of sales. The company's CEO setting a goal of delivering 550,000 cars this year, a 34% increase from last year. And Apollo is looking south for a possible second U.S. headquarters. According to the Financial Times, the asset manager is considering a new location in several cities, including Austin, Nashville, or in South Florida. That's your Bloomberg Brief, John.
Yahira, thank you. Appreciate the update. Up next on the program, Fed policy on pause.
Everyone realizes that a policy response doesn't help get ships faster through the strait. A policy response doesn't help really offset demand destruction. The Fed hiking is not going to get oil to flow more freely. They are going to sit this out.
Up next on the show, Al-Hussainy of Columbia Threadneedle from New York City this morning. Good morning. You're watching Bloomberg Surveillance. A new statement from the president out a little bit earlier on this morning. It reads as follows. The United States of America in serious discussions with a new, more reasonable regime. He calls it great progress in the talks so far. But if we don't reach a deal, this is the threat: to obliterate all of their electric generating plants, oil wells and Kharg Island, and possibly also desalination plants.
That would be a real escalation that would lead to retaliation from Iran, attacks on other civilian infrastructure. There is a real question here. Does this indicate that they are closer to talks, or does this indicate there is another deadline coming up that we need to pay attention to?
It's a new era for financial markets. These statements just don't move the dial at all. You had an initial spike in equities, and since then we're where we were, up by about 0.6% on the S&P. Similar story in the bond market. Yields still lower by 5 basis points on 10s, and in the commodity market still around 115. There was a time, maybe a week ago, when that kind of statement made a big difference, at least for a few hours, not even a few minutes anymore.
It initially was treated as signal, now it's treated as noise, because ultimately you've got both sides trying to jawbone the market into moving in a certain direction, and people are watching other things right now, like the physical market, like other potential nodes of progress.
So where does it leave the Federal Reserve? Under surveillance this morning, Fed policy on pause.
Everyone realizes that a policy response doesn't help get ships faster through the strait. A policy response doesn't help really offset demand destruction. If oil goes to $150 a barrel, right, there is an element of demand destruction, and the policy response doesn't help with that. So I don't think the market is counting on that. The Fed hiking is not going to get oil to flow more freely. They are going to sit this out.
So here's the latest this morning. Fed Chair Jay Powell speaking at 10:30 Eastern Time. Traders looking for insight as higher crude prices increase the odds of an economic slowdown. Al-Hussainy of Columbia Threadneedle writing, it's in the Fed's interest to keep markets on edge. Doubt is their most powerful tool to keep inflation in check. Ed joins us now for more. Ed, good morning.
Good morning.
Is that how you describe this then? The first phase is a big communication push.
I think that's right. You want to create the permission structure for markets to price tight monetary policy up front. Then as we see inflation, as we see growth develop later this year, I think it opens up room for cuts. But the initial stage, you want to make sure that markets feel that the Fed's responding with sort of a whatever it takes posture.
How do you price that sequencing through this yield curve?
I think we've done a good amount of work. We've taken out about 2.5 cuts. We've taken that pricing to roughly neutral, maybe half a hike in the price. We flattened the curve, right? If anything, in the extreme, if this conflict continues, we could invert the curve. And that would be very consistent with the Fed tightening policy in the background to make sure there are no second round effects from this.
So then how do you understand the back end of the yield curve, the 10-year, the 30-year, and the fact that yields have moved higher? Is this a lack of credibility that the market has that they truly can contain inflation?
I think the answer is twofold. One, not yet. Most of the repricing has been in real rates. So it's been a tightening of policy. It's been a tightening of posture. The initial reaction to me is a couple of things. One, there's some technicals behind this. The market was positioned for cuts. It was positioned for a steeper curve at the end of February. We've unwound all of that. We haven't had time to price in the hit to growth in the labor market yet. I think it's starting to get a look now as we get, 30-year yields to 5%, 10-year yields to 4.5%. Those things start to become more durable ceilings. But I think the key question for an investor today is, which part of the curve is overshot? Is it the longer end of the curve or the front end? And I think I put a lot more chips on that longer end of the curve.
So you believe it's going to be a greater growth shock than people previously expected. I'm just wondering how the fiscal lever plays into this, given the fact that the previous declines in growth have been met with huge fiscal responses. And we see a similar type of impulse coming right now, at least in the rhetoric from Congress.
Absolutely. So that's a little bit of a wild card right now. The fiscal posture right now in the background is roughly neutral, not a lot going on. It's a little bit more accommodative in China, in Japan, in Germany. To the extent that there is room to really ramp up fiscal stimulus the way we did after COVID, I think that room is a lot tighter. I think Congress has learned the fact that, look, you really need a different rate environment. You really need a different growth environment to drop stimulus into the economy without facing significant consequences. So I'm seeing a little bit of adjustment on the margin, gasoline taxes and the like, but large fiscal stimulus so far is not part of the picture. But that's a massive risk for bond investors.
Is there a bond market you're worried about? I looked at Japan, highest yields across some tenors since the late 1990s, the UK since 2008, Germany since 2011. Is there a market you're more concerned about versus others?
I think some of the volatility you see in UK rates, for sure, is symptomatic of the fact that, look, there's very little capacity for that market to absorb additional supply. That's one. Two, a lot of the participants of that market are leveraged hedge funds. They moved their positions around very quickly. You see that in the rate volatility. But if I zoom out, I would be most worried about emerging markets, particularly local currency emerging markets. This has put significant pressure on them, both directly through the inflation oil shock and indirectly through a stronger dollar. So to the extent that emerging markets were a real sweet spot last year, a really nice runway for cuts, that's gone. And a lot of them will have to tighten policy pretty significantly. So from a growth perspective, that feeds back in a nasty way.
That is just brutal. They don't get just hit once, they get hit twice, maybe three times.
And how many people were positioned for emerging markets to outperform heading into this year? They thought that they would benefit from the tailwind of global growth continuing to expand and potentially at a faster pace, the rest of the world outperforming the U.S. How much things have been completely turned on their heads in just 1 month.
Forgive me for shortening this down to about 30 seconds. That's all I've got. Do you think there's an underappreciation still this morning about energy rationing in EM and the hit to growth we're about to see?
Yeah, absolutely. Absolutely. We're starting to see that in Asia, particularly in East and South Asia. That's starting to play through in the physical markets. It's the place where manufacturing is concentrated and so most sensitive to the inflation and the energy shock story.
Ed, thanks for making time for us.
Appreciate
it. Lots to think about. Ed Al-Hussainy there of Columbia Threadneedle on emerging markets and the pain that they're in right now. The hit through energy, the hit through foreign exchange and the hit through rates.
Yeah, and the hit through having to wait online to get oil because you are seeing a physical shortage in a lot of these countries.
Up next on the programme, we'll catch up with Biel of Kayne, Anderson, Rudnick, Mehta of Goldman Sachs, Nancy Lazar of Piper Sandler, Ed Yardeni of Yardeni Research. The third hour of Bloomberg Surveillance up next.
The level of uncertainty is extremely high.
Things seem to be in a free fall. You don't want to catch a falling knife.
Equity markets and markets generally are resilient.
We still see a compelling stock or equity story ahead.
It's just so difficult to determine what's going to happen next in this market.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your price action, your scores look like this. Holding on to gains, up by 0.6% on the S&P 500, up by 0.5% on the Nasdaq, following the biggest weekly decline of the year so far. In the bond market, yields starting to run here. Bonds starting to rally. We're down by 4 basis points on twos. We saw this in Friday's session. At the back end of the session into the weekend, this is the follow through. We're down 5 basis points on 10s to 437. And crude holding on to gains also. WTI and Brent crude. Brent at around 115, up by 2%, with some encouragement from the president and also a rather large threat. The president saying talks are going well. Progress is being made. But if we don't make a deal, there's a big stick at the other end.
So how do people trade this? And ultimately, they don't. Initially, there was a pop in equities, no real move in oil. Right now, people looking at what are the off-ramps, right? How do you have a taco-type trade? And Trump always checks out, which is not the right way to phrase this at all. But how do you have an off-ramp at a time where it seems to be only escalations that could potentially get you to that de-escalating point?
What's changed in the last week for the better? The answer to that is not a lot. In the last week or so, two-way risk has persisted. This can go one way or the other, conclude, or it escalates. But in the meantime, as it persists, the problems just accumulate. And this was the story on Friday for so many people. The longer this goes on, the problems persist, things start to accumulate, it gets harder and harder to rebound from. And that's what I wonder is starting to click into the bond market. Yields down on Friday, down again this morning, the focus shifting from inflation to growth. We'll see if this holds. It's only a few days, but it feels like the story is starting to adapt, change into a new phase.
Yeah, there is the sort of belief that the longer this goes on, as you say, the worse it's going to get. I find it interesting that initially we were talking about if it goes on for more than a month, it could be a problem. Now, if it goes on for a couple months, it could be tolerable. But if it goes on through December, well, God help us all. And there's this question of at what point do you get that trigger of full capitulation, or have we already seen it? And you now have some analysts coming out and saying you have already seen capitulation in certain pockets, and now people are going back in. Ultimately, I don't know how you get a handle on this market.
What has changed is if you ignore what Trump says, what he does has changed. And that's the sense that there already is a Marine Expeditionary Unit in the region. There's another amphibious assault ship heading to the region, and the 82nd Airborne was already deployed. So things on the ground have actually changed, which show that this administration is serious when it comes to escalating to de-escalating. The president in this truth is just giving the Iranians potentially one last chance for an off-ramp.
Here's another thing that's changed, and it's the data. It's an early read on how inflation's going to look, how things will change through the month of March and into April. This from Germany. CPI year over year. It was 2%. It's now 2.8%. Get used to seeing more of those kind of numbers over the next few weeks.
Yeah, and actually, I would say that these are the data points that actually are going to be much more interesting than even the key jobs figure that comes out on Friday. Not only the CPI that's going to be released in Europe throughout the day, but also the ISM manufacturing numbers and prices paid that we get on Wednesday. That's the real-time information that a lot of people are looking for to understand exactly what companies are having to fork over and what kind of potential hit there could be to growth.
Big hour coming up. Coming up on the program, we'll catch up with Judy Biel of Kayne, Rudnick as President Trump renews threats against Iran if a deal isn't made soon. Mehta of Goldman Sachs with crude prices heading for a record monthly rise. And Ed Yardeni of Yardeni Research saying the bond vigilantes are making a comeback. We begin this hour with our top story. President Donald Trump pushing Iran to make a deal, renewing threats to strike energy infrastructure and more. Bloomberg's Jemana Basechi joins us now from Dubai. So, Jemana, on the one hand, we're making progress. On the other, those threats still linger.
Well, I'm going to take you back 8 hours. When I was doing my show, U.S. futures were down 0.5%. And then President Trump gave some comments to reporters on Air Force One. He indicated that they could be making a deal with Iran in the next few days. Futures went positive. And then obviously now he's come out with this post suggesting that they could be probably making a deal with a more reasonable Iranian regime. If not, then, of course, he has threatened once again to strike some of those power plants and key energy infrastructure units in Iran. Now, the point here is who exactly are they talking to? And this is the question that we raised last week. There was an opportunity for the two sides to meet in Islamabad over the course of the weekend. We know that a meeting took place mediated by Pakistan, but with foreign ministers of other regional powers there. We had Egypt, we had Turkey, we had Saudi Arabia. We did not have Iran representation, and we did not have U.S. representation. So most definitely there's an attempt from the region, at least some of the mediators from the region, to push through the diplomatic channels. But then the question is, who is going to be the person on the Iranian side? President Trump himself has said essentially that the Ayatollah is non-present, the new Ayatollah. Nobody's really seen him since he was appointed a couple of weeks ago. You have the Speaker of the Parliament who continues to taunt President Trump on social media and in fact has mentioned his jawboning of the market. And then you have the Foreign Minister, Abbas Araghchi, who just a couple of days ago has mentioned the lack of trust between the two sides. And he specifically referenced the fact that on the day that President Trump pushed back that deadline to April the 6th, Israeli strikes, then the Israeli forces conducted some strikes against steel facilities and those nuclear research facilities in Iran. And on the back of that, they had to retaliate against some of these Gulf Arab states. So there's a question of trust here, but then also who exactly is going to be representing the Iranians on the other side and whether that person actually has the clout to convince the clerics and also the hardliner Revolutionary Guards. So, as ever, I think you have to read this with a grain of salt, but there is an attempt from the region to de-escalate. At the same time, let's be mindful of all of the troops and the military assets that are being deployed to the region.
Jemana, just one line in the president's statement at 7:30 jumped off the page to me, and it was in brackets, desalination plants. Jemana, you're in Dubai. How concerned do you think Gulf partners would be about the prospect of them striking desalination plants?
John, Iran actually hit a desalination plant in Kuwait over the last 24 hours. And it hasn't been that, it's sort of gone a little bit under the radar, but actually many Gulf Arab states are very quick to condemn that attack. It didn't actually cause any disruption to water supplies in Kuwait, but it does tell you that this is a key and would be a key game changer for the region, not least because around 90% of the water that we consume over here in the GCC region comes from desalinated water. It would be deemed an extreme escalation and an outcome that everyone over here wants to avoid. So initially, when he postponed that deadline to April the 5th, it was met with a bit of relief. But from Iran's perspective, and at least the fact that they went after this Kuwaiti desalination plant over the weekend suggests that from their perspective, anything is on the table still.
Jemana, I appreciate the update. Thanks for making time for us. Jemana Basechi there of Bloomberg, leading our coverage of this war out of the region. To state the obvious, that would be a major, major escalation.
That is the bulk of the water, as she said, 90%. When you look at some of the regions, it's actually 99% of the water for Qatar, right? So you're talking about some of the attacks here. What you end up with is a crisis that is humanitarian in nature very quickly, and that's what everyone in the region and beyond wants to avoid.
Already we're seeing humanitarian crisis in the sense that there have been civilian infrastructure that's been hit, and also humanitarian crisis on serious levels in Asia when it comes to the energy shock. But if desalination plants were hit, that is going to be massive across the region. And you'd probably see mass migration, individuals just trying to catch any flight out anywhere for safety.
Let's get to the markets. Difficult to make that transition, but we've got to. Let's talk to Judy Biel of Kayne Anderson Rudnick. Judy, welcome to the programme. Stocks are higher, bond yields are lower. Can we sit on the bond piece of things first? It felt like things switched on Friday in the back half of the session where investors began to price in lower growth and lower yields. What do you think is behind the move?
Well, I think people are starting to really recognize that, you know what, I think these oil prices are probably here to stay because there's so much damage to the infrastructure. And if that's the case, we know that there can be real meaningful demand destruction. And a lot of what led inflation, right, in the last period of the 2021-2022 period was just too much demand for too few goods. And so if we have real demand destruction for the worst reasons, right, just the paycheck is eaten so much by oil prices, it is a negative thing, but it does mean that there are limits to how inflationary this time period can be, and I think what it can mean for the overall growth of the economy.
What does it mean for how long the Fed will sit this out before they step in and do something about the hit to growth?
I do think that until we have more clear data, it doesn't make sense for them to make a lot of movements one way or the other. Their biggest problem is just that the data itself is so noisy, right? We've had so many adjustments in terms of jobs. We had all of the problems in terms of the government shutdown. It makes it really difficult for them. And I think that their upside and downside scenarios of whether they make a move, whether it's to cut or to raise, it's high. So for them, I think that there's just more benefit in being able to stand pat before really making a decision.
Julia, there's been a discussion around complacency in markets, a sense that in risk assets in the U.S. in particular, there really hasn't been recognition of some of the carnage that we're seeing expressed in oil markets, particularly physical oil markets. What's your sense of just where sentiment is right now in risk assets?
I think that most people have a lot of anxiety, and there's good reason for there to be anxiety, right? It's not just this. It's, is AI going to continue the way that we're hoping it is? Are we going to see a meltdown in private credit? Most people that I talk to, they're not having a great time at the office these days. But I think that there's a force that's more powerful than that. Let's set aside FOMO. FOMO is something that happens in college. It's POMO, the pain of missing out on a day like last year when we had post-Liberation Day and Trump said, never mind, and the markets rallied 9%. If you were not on risk assets at that time, you had a very hard time making it up for the rest of the year. There's real pain in not being in the market when things revert really quickly just on the blink of an eye. Now, it's interesting, right? Because based off of Trump's comments, people are starting to realize there's a little bit of a boy who cried wolf element to that. But I think that really limits how much people really get risk off. They can be realistic, they can have a little bit of a cash position, but they recognize that things can change very quickly. And if they miss out, it really hurts the rest of the year.
How long can this go on, Julie, before people realize that there's not going to be a quick snapback like what we saw after Liberation Day?
I think that there really has to be a recognition of not just prices at the pump, but prices through the rest of the supply chain, I think is the moment that people recognize that this takes more time than expected. And I think what's very difficult is this war feels very, very opaque to a lot of people. If you remember just the Iraq war, right? Every day on the news, you had images of what was going on there. And now we have an administration that prefers to use memes and cartoons and movie clips to describe this war. So I don't think people have any real indication of what the damage looks like and how long lasting it really is. It's very easy to kind of blow up infrastructure. To rebuild it is very, very painful. And I think it's unclear how companies can really shift their supply chains around when an input as basic as oil, as fertilizer, as natural gas ripples through the rest of the pricing.
Julie, it's always good to catch up. Thanks for jumping on for us. Julie Biel there of Kayne and Rudnick. Her reaction to that statement from the president just moments ago and her thoughts on where we are in this market. Plenty of debate on Wall Street about how well priced we are for a hit to growth. Morgan Stanley's Mike Wilson really pushing back this morning for his note to start the week. We think the equity market is less complacent on growth risk than consensus believes. The S&P's forward PE ratio has now compressed by 17%.
At the same time that you're seeing earnings expectations increase from a lot of companies, and a number of different strategists have pointed to this, adding that the United States is in a better position strategically than the rest of the world based on its oil and natural gas supplies. That said, at a certain point, you're going to start to see consumer demand, and you're not seeing it to the extent that some people would expect in consumer discretionaries.
Just about holding on to gains this morning on the S&P 500, following an almost 9% decline off the highs earlier this year on the S&P. We're positive by 0.6%. Let's get you an update on stories worldwide with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. President Trump posting new threats to Iran. Trump saying that the U.S. will destroy Iran's electric plants, oil wells, desalination plants, and the key sites of Kharg Island if a deal is not shortly reached to reopen the Strait of Hormuz. The president saying a deal will still, quote, probably be reached. Banks led by J.P. Morgan are facing pushback on the terms of a $7 billion debt deal to fund a takeover of Sealed Air. Sources telling us here at Bloomberg that the deal is sparking concerns. It could give private equity firm CD&R the option to spin off either Sealed Air's food or protective reporting units. And Air Canada's CEO is stepping down following the deadly runway crash at LaGuardia Airport. Canadian Prime Minister Mark Carney reprimanded the CEO for releasing a statement in English with only 2 French words. The airline is headquartered in Montreal, Quebec, where French is the primary language. That's your Bloomberg Brief. John.
Hey, you too.
Yahara, thank you. Appreciate it. Up next on the programme, The Morning Calls, plus Neil Mehta of Goldman Sachs, with President Donald Trump renewing his threats to destroy Iranian energy infrastructure. Live from New York City this morning. Good morning. Stocks holding on to gains up by 0.6% on the S&P 500 following a fifth consecutive week of losses on the S&P, the longest losing streak going back to 2022 on the S&P 500, down from the highs by almost 9%. This morning, a bounce of 0.6% following the biggest two-day decline going back to April. It's been painful in this equity market. It's not just been about the Middle East. Big tech in focus too, and those problems predate this war.
It's a question about how much they're spending. It's a question about AI disruption. It's a question about regulatory pushback, given the lawsuit that Meta lost over social media and the influence there. That said, you do have a growing number of contrarian investors saying maybe this is a time to buy, given the fact that the earnings picture looks pretty good. Question is, how much are those earnings upgrades factoring in the higher hit from prices that we're going to see from oil, that we're going to see from gas for a long period of time?
Are we starting to price in slower growth? Check out the bond market, 2s10s30. Something happened at the back half of the session on Friday. This equity market closed at the lows. The two-year yield did as well. And we're down another 5 basis points this morning, 3.86. Starting to push out that rate hike stuff and starting to price in a much bigger hit to economic growth.
Yeah, people had gotten carried away, according to some strategists, with how many rate hikes they've been pricing in, particularly in Europe. Now the question is, how much can they really hike rates into a growth shock, as has been every single previous oil spike that we've seen to date?
Brent crude right now, 115. WTI triple digits, 101. That's the price action. Let's get you some morning calls. First up, Jefferies upgrading Expedia to a buy, saying it's less exposed to geopolitical risk. That stock is up by 2.5%. Your second call from Morgan Stanley, cutting its price target on Meta to $7.75, noting fears around Gen AI is weighing on sentiment. Meta up this morning, but down hard last week, negative 11% just last week. And your third and final call from RBC, raising its price target on Kinder Morgan to 35, highlighting commodity prices as a benefit to its estimates. That stock is up by a little more than 1% this morning. Let's down our top story. The president renewing his threats to destroy Iran's energy infrastructure, including Kharg Island, if no deal is reached to end this war. Neil Mehta of Goldman Sachs writing the following: if commodity prices surprise to the upside in 27, as our analysts now forecast, it would provide support to our base case valuations, which use a view of $75 a barrel on Brent. Neil joins us now for more. Neil, good morning.
Thank you for the opportunity.
Hey, it's good to see you. Let's break it up. Upstream, downstream, but let's start midstream.
Yep.
How squeezed are all services right now?
Yeah, so I'd say oil services companies, there are a number of them that we do have a constructive view on still, Halliburton and Schlumberger as well, SLB. I would say activity in the Middle East is definitely going to be down. You will see a pickup on some activity here in the U.S. I would say, but as we look at the outlook on a multi-year basis, there are still some opportunities here in the services complex, particularly Halliburton, which is a good blend of the U.S. side and the international side.
Before we turn to the Middle East and the damage done, just on the U.S. side, how tight is the relationship between activity and price?
Very tight. I would say as we look today, EBITDA per fleet is around $18 million. At peak, we were in the 30s. I do think there's an opportunity for some pricing for U.S. land to move back into the mid-20s here.
Before we get to that destruction, how much are you seeing any oil companies considering in the U.S. increasing production in response to the increase in pricing?
Yeah, we spent a lot of time over the last couple of weeks spending time with our management teams trying to evaluate whether there will be a change in activity. And so far, the answer has been it's quite muted. I think when our companies make decisions about taking up activity, they're not looking at the front of the oil curve, which, as you noted, is $115 a barrel. They're looking at the backs. They're looking at 27. They're looking at 28. The deferred oil price is still in the low 70s Brent. And so it's not giving a signal to the market to meaningfully increase activity. And I think the big picture is that the U.S. has gone from 5 million barrels a day to 13 to 14 million barrels a day. So shale is already at a point of relative maturity. Inventory is starting to get dwindled down a little bit. And so the companies have less inventory to aggressively grow into, which is part of the reason we're long-term constructive on the price of oil, because as shale matures, demand still grows and there are fewer projects internationally. It does set up for a more constructive long-term price environment, notwithstanding the front of the curve, which I think is fairly impossible to predict right now.
Well, the back end of the curve, let's get into that, given the fact that you're pretty constructive on that going higher. In other words, oil prices going higher than they currently are 6, 12, and even 24 months out. Part of that is the destruction to facilities in the Middle East. Yeah. How much do you see actual real destruction to both natural gas and oil facilities that could potentially take years to come back online?
I think that In our coverage, the one asset that has been impacted is Qatar. The Qatar LNG facility, which is in the process of growing and will continue to grow over the next couple of years. ExxonMobil has two trains that were impacted significantly. It's difficult to know the magnitude of the damage. The operator is saying it could extend 3 to 5 years to get that fully repaired. Some of those expansions, Northfield South expansion and then the Northfield expansion itself, are likely going to be delayed. For our modeling purposes, we push it back about 6 months. And so this global gas glut, which looked very apparent for 2027, does look like it's been pushed out to the right. As far as oil, I think it's too early to make that call, whether there's been meaningful infrastructure impacts. We'll continue to watch it. At a minimum, we need to start talking about putting geopolitical risk premium back into the long end of the oil curve, which in the low 70s doesn't reflect the increased risk, especially with dwindled OPEC spare capacity in the market.
Let's stay on that. This is an important topic because some comfort in the equity market is coming from the backwardation in the curve.
Yep.
Just the idea, if you don't follow crude closely, that crude prices looking further out, are lower than where they are right now. How far up do you think they need to come? From the 70s to what?
Yeah, our base case modeling, as we said, was $75 Brent. The bias on the long term would be higher for 3 reasons. 1, shale is maturing. 2, you have demand that's going to grow on our modeling till at least 2035 with the bias that it's actually longer. And 3, when we modeled the large projects, we call them the top projects that are coming in, there are a ton of projects that came in 25. There were a ton of projects that came in 26. There are very few projects, big projects, that come in 27. And at the end of the day, the backs are also going to be correlated with the extent of OPEC spare capacity. Saudi's producing in the low 10s right now. I think they will struggle to produce well above 10.5 to 11 on a sustained basis. So when you have OPEC spare capacity that has now been dwindled down, along with the maturity of the U.S. and the growth, I do think you need to move higher. We use 75 for modeling. It is not crazy to think of scenarios where the back end needs to move into the 8 handle.
Let's say we get to the 80s. Who's best positioned to take advantage of that curve?
You want to own the companies that have long depth of inventory. And so I think that the stock that we have on our conviction list right now is ConocoPhillips. I think if you have an asset in the United States, meaning lower 48, like the Permian, or Alaska, or Canada, it is inherently more valuable today than it was on January 1st. But you need to have depth of inventory, which there are fewer companies that have it. ConocoPhillips is that stock for us.
That stock right now is up in a pre-market by 1%. Neil, it's good to see you. Thank you, sir.
Great to see you.
Neil Mehta there of Goldman Sachs on this energy market and adjusting the long end of the curve.
Yeah, given the fact that there is some destruction to these plants, but really more importantly, and it's the point that Jeff Curry was talking about, that risk premium that needs to go on pricing based on the geopolitical backdrop, something that a lot of people are talking about, doesn't seem to be priced in at this point.
Up next on the programme, we'll catch up with Nancy Lazar of Piper Sandler, looking ahead to a busy week of economic data. Danny has your morning movers, energy stocks jumping on renewed infrastructure threats, plus this. Don't miss this. In a few minutes' time, Annmarie back in the studio right now, just getting off the phone from a conversation with the President of the United States. The headlines from that conversation on the other side, that's about 3 minutes away. A lot of damage was done in this equity market last week. On the S&P 500, the worst week, the biggest weekly decline we've seen so far this year, going back to October. On the Nasdaq, the worst week since April of last year. On the Nasdaq this morning, higher by 0.75%. On the S&P 500, likewise. In the bond market, yields down across the curve. 2s out to 30s, 10s down by 5. Call it 6 basis points lower at 437. As these moves hold, Brent and WTI. Brent crude at around 115 all morning, 114.70 right now, and WTI back in triple digits, 101. Moments ago, Annmarie on the phone with the President of the United States, speaking to him about where we are in this war.
Very briefly, he said he's very busy this morning, but he wanted to reiterate that he thinks the United States is doing very well. The war, he says, is going, quote, unbelievably well. And then this is what he left me with that stuck with me. They want to settle. He said, that's all I can say. They want to settle. So right now, the president of the United States is projecting and socializing to me and the world that the Iranians want to settle, as this comes off the heels of his long Truth Social post where he's saying almost this is your last opportunity to go to the table, or there's going to be massive reckoning when it comes to what he is calling things that he wants to, quote, obliterate: electric generating plants, oil wells, Kharg Island, and maybe even desalination plants.
At the same time, the Iranians are denying they're engaging in a diplomatic effort. Through the Iranian state media again this morning, they say they didn't participate in the meetings in Pakistan. They say the U.S. demands are excessive. The president says we're making progress. I think we're all trying to figure out where precisely we're making progress.
Where is the progress made? Also, when his Truth Social post came out, when he talks about if a deal is not shortly reached, what does shortly mean? Are we talking about days? Are we talking about weeks? Or are we talking about months? So I think it's important to remember not so much what the president says, but what he does. And what has changed over the course of the last week is now we have Marines in the region. We also have soldiers in the region right now. And potentially, given the reporting over the weekend, the president of the United States is weighing sending even more.
There is a self-imposed deadline. That self-imposed deadline currently is April 6th. And now we know the additional threats read as follows from the president: obliterating all of their electric generating plants, oil wells, Kharg Island. And in this statement from the president earlier on this morning, the threat of possibly all desalination plants. And I keep going back to that because I imagine that's going to make partners in the region very nervous.
That's the bulk of their drinking water for civilians. There was a desalination plant that was hit in Kuwait, as we were hearing from Jumana. A question about how much this would escalate. Also a question of how there is some sort of agreement that could potentially come to the fore. It is the fog of war on steroids. There is a sense that nobody can really get a handle of what's going on the ground, what's going on around the ground. And that's part of the reason why there is a huge range of outcomes that are potentially at play here.
And the president, in his truth, and he talks about this a few times, he does feel like the regime has changed, even though it's not what he says, regime change. It's changed within, meaning top brass has been taken out. But a lot of analysts you talk to will say that the individuals he's still dealing with, maybe some of the lower level that are now rising the ranks because the others have been eliminated, they are hardened by what has happened. These are people who are still trying to avenge for Qasem Soleimani, and now they have to avenge for the Ayatollah and others who were taken out by these Israeli strikes.
That's the setup this morning. Stocks are positive by 0.8%. Let's get you some morning movers. Danny's standing by with more. Hey, Danny.
Hey, John. I want to look through some of the industries that have been affected from the war in Iran. First, starting out with the best performing sector month to date. It is no surprise. It is the oil majors, Exxon, Chevron, Occidental Petroleum. They're all up this morning off the highs of this morning. They did seem to reach there after the president's Truth Social post, talking about, as you've been saying, negotiations, but the threat of escalation. All of these companies up in the low teens so far this month. Then there are the fertilizer companies. This is interesting because they've had a little bit of a varying fortune. CF Industries, for example, is up 13% month to date, but Mosaic is actually down. The Strait of Hormuz, also an important waterway for getting various components that go into fertilizer, something we've been tracking. These are also holding on to their gains, up around 1.5% for all these fertilizer companies. Finally, the new grouping of companies that have joined in on the rally over fear of what's happening in Iran is aluminum companies. They have been falling month to date because there was a fear of slower growth because of what's happening in the Middle East and that's effect on inflation. But now we learned over the weekend that aluminum producing plants were hit from Iranian forces and strikes. So Alcoa, Century Aluminum, they are up double digits this morning, John, 10.7% and 12.6% for Century Aluminum.
Danny Berger, thank you. Danny, appreciate it. Look out for Danny Berger at the top of the hour, about 25 minutes from now, to guide you towards the opening bell at 9:30 Eastern Time. Looking ahead, a busy week of economic data on deck, wrapping up with the payrolls report this coming Friday. Also later on this morning, the chairman of the Federal Reserve speaking at 10:30 Eastern Time for a preview. Bloomberg's Enda Curran joins us now for more. And how useful, how instructive is this data this week?
Well, look, payrolls is going to be the highlight, John. There's no doubt about it. Expected increase there of 60,000 jobs added, reversing that big 90-odd thousand decline in February. Unemployment expected to stay around 4.4%. There's some idiosyncratic factors there around weather and a health strike behind that rebound. But nonetheless, if those jobs numbers come in on Friday around those numbers, that indicates that the labour market is as you were. It's not necessarily very strong, but neither are we in the mass layoff territory just yet. That, of course, feeds into the whole broader Fed story about, their scope to cut, or are they going to stay on hold? It would surely suggest they have room to stay on hold, perhaps for a little while longer. We also get retail sales this week. That will be important to keep an eye on, expecting some firm numbers there in the back of car sales. And then, John, as you mentioned at the beginning, we do, of course, have Fed Chair Powell coming out later today. He may or may not give some new signals on what he's thinking about the impact on energy prices and inflation from the Iran war, but probably not expected to move the needle too much, I think, given he just spoke only recently after their policy decision.
And what is the current posture of the Federal Reserve? What do they seem to be getting behind at the moment?
I think it's, very much a wait and see, John. We had that a few weeks ago with Chair Powell after the Fed press conference. They don't yet know. It's probably an open mind in terms of how the energy shock will ultimately impact core inflation. We all know that, yes, prices will go, inflation goes up near term, but do they look through that and wait to see what the second round effects are on in terms of people's spending, in terms of the impact on businesses and households? As I say, we get the retail sales data this week. They're expected to hold up, but eventually that shoe will start to drop. We're in the worst energy shock in decades. It is expected that will start to hit business people, small businesses, large businesses, and households. And when that impacts confidence and spending, then you'll start to see, I think, some movement in the Fed debate. But right here, right now, I think it still remains very much, they don't yet know, too much uncertainty, and they kind of want to see how this plays out in the weeks ahead.
They're looking to sit this one out, at least so far. And a thank you, and a current down in Washington, D.C. Nancy Lazar of Piper Sandler writes the following: ignore the unreliable and often revised payroll data, which are currently weak. Nancy joins us now for more. Nancy, good morning.
Good morning.
Is this war another reason to ignore?
For sure. Payroll employment is just a lousy data set. If you were the company that produced payroll, would you as an investor buy that company? Their data are constantly being revised down. Since 2022, 80% of the time payrolls were revised down, and then at the end of the day, we got the QCEW data, and it was revised down another almost 900,000. So, to be sure, the war could clip employment growth, but payrolls are not the data to look at. Unemployment claims are a much better measure of actually what's going on from the labor market perspective.
Well, looking at claims, it screams things are absolutely fantastic right now, around 200K.
Yeah, I did some work over the weekend, and unemployment claims have high correlation with swings in employment. I tend to use the household employment data, and they're suggesting, if anything, we should be seeing a reacceleration in employment growth. We saw the regional Fed manufacturing indices last week, and their current and future employment indices were all up. And so claims aren't the only measure out there suggesting the labor market is healing.
It seems like the labor market right now is taking a backseat just because it's a slower moving train than some of the other indicators that could be coming out. We got earlier, as John was mentioning, Germany's preliminary harmonized CPI, which came in at the fastest pace in about a year. You have the ISM manufacturing data coming out from the United States. How much more important are these data points, given the fact that we're looking for real-time influence?
So higher oil prices impact CPI data very quickly, if not immediately. And so we would, it's not surprising you saw the German data. We're going to get our data later in the month. They're going to show a pretty big increase of 0.6%. But historically, it does take time for changes in oil prices to work their way into the economy. It can't just be a one-time blip. It needs to be a sustained shift up. And so I would argue that looking at the employment data that we do have, that's reliable, the fact that it's healthy, is a sign that we have a pretty strong backbone. I overuse that word. Pretty strong backbone in the U.S. economy. Business confidence is solid. Earnings are improving, not just large companies, but smaller businesses. And so, to be sure, this oil could derail things. But at the end of the day, going into it, unlike 1990, unlike 2008, the backbone of the U.S. economy is pretty healthy.
There are two potential scenarios. On one hand, this would be a real hit to growth and potentially would pressure the Fed from having to or being able to raise rates in response to some sort of shock. On the other hand, if you do think that the economy is that strong, why isn't this even more of an inflationary shock that would prompt some sort of response from the Fed?
Well, the economy is solid. I don't want to say it's strong and at risk of overheating. There's a difference. We are in the early stages. Our view was of a reacceleration in the economy where you don't yet have a labor market strains where you don't have a labor market, to say the least, that's too strong. So we're early stages in this improvement in the labor market. So our argument would be energy is a tax on the U.S. economy, similar to what we saw in the world economy, similar to what we saw with the tariffs a year ago. And actually the Fed in the back half of 2025 cut rates because it was a headwind. We're not looking for any change in Fed policy. That's not what I do. But given economic conditions, we would argue that the Fed doesn't need to cut rates. And this health in the labor market and business confidence and manufacturing surveys would all point in that direction.
Nancy, it sounds like you think what the Fed does is what they did with tariffs. Look through it. It could potentially be a hit, but it's only once. Yes. Price adjustment.
Exactly. It was a one-time hit. They understood that. This is very different than the 1970s. This is not stagflation a la the 1970s, when you had double-digit increases in both money supply and government spending. The Fed way behind the curve, shoving rates down too low. Nixon put in place wage price controls, 71, 73, which totally distorted the inflationary backdrop. And so this is not a stagflationary environment. We think this is a obvious temporary risk to the economy associated with a one-time hit to higher oil prices.
How do you define temporary? We're already a month in.
Good point. The duration does matter here. And our view has been that it takes time for higher oil prices. We saw that back in 2021. Oil rose sharply in 2021. And it wasn't until early 22 that you started to see the effects of that. So if this were to last for 6 to 12 months, then I would worry. We have 3% kind of as our base case for growth in the United States. 3% this year, 3% maybe even in 27, given monetary fiscal policy and productivity. But at the end of the day, if you do move up toward 100, 120 and stay there, that 3 is at risk of shifting down something closer to 2%.
Nancy, good to see you. Thanks for the update. Thank you. Nancy Lazar there of Piper Sandler. I don't even want to begin to think about what it would look like if the Strait of Hormuz was still closed 6 to 12 months out.
This is all people care about. And as we were talking about why the labor market report isn't going to matter, Andrew Hollenhorst puts out a note saying the labor market report isn't going to matter. Even if the jobs report is more surprising, energy prices may continue to dominate fundamental economic data in the U.S. In other words, we can't game them out, but those concerns are what hover over every single projection out there on Wall Street.
And the Strait of Hormuz at this moment is just one risk, now added with the Houthis entering into the conflict this weekend. Potentially, if you start to see any sort of conflict or the Houthis firing off missiles or drones in the Red Sea, that is also going to impede the flow of traffic in the Red Sea and the Bab el-Mandeb Strait. And then you have 2 choke points. I don't see how Brent stays at this level. I don't see how it doesn't go closer to $150 a barrel.
Brent right now around 115, 114.50. Let's get you an update on stories worldwide with your Bloomberg Brief. Yahara has more. Hey, Yahara.
Hi, John. President Trump posting new threats to Iran on Truth Social. Trump saying that the U.S. will destroy Iran's electric plants, oil wells, desalination plants, and the key sites of Kharg Island if a deal is not reached soon to reopen the Strait of Hormuz. Annmarie spoke to the president a few minutes ago, and he told her Iran wants to settle. The Spanish government announcing it's closing the country's airspace and bases to U.S. planes carrying out missions in Iran. Spanish newspaper El País reporting that the country is only allowing the transit or landing of planes in cases of emergency. And for the first time in more than 50 years, NASA is sending astronauts back to the moon. The Artemis 2 mission is set to launch on Wednesday. It will take the astronauts on a 10-day journey that will go to the moon without landing and then return to Earth. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate the update and thanks for this morning. Up next on the programme, we'll set you up for the day ahead. Plus, Ed Yardeni of Yardeni Research saying the bod vigilantes are making a comeback. That conversation up next.
Inflation risk is already being priced by the rates market. That's why you're seeing the yield curve flatten quite significantly. The front end is up. So I think we take a step back and say, what if oil stays, let's say, 100 or above for an extended period of time? In the worst case, it's not just inflation, it's growth. It means your curve can actually get inverted.
That's the worst case. It's not their base case. That was Krishna of Barclays. The base case is earnings are going to be fine. And this S&P 500 could climb to 76.50 by year end. They actually increased their target on the S&P 500 in the last week against the backdrop of a war that continues. Equity futures near session highs, up by 0.8% on the S&P. On the Nasdaq, up by 0.75%. Yields are down across the curve, 2s, 10s and 30s. 10-year bond yields declining by 6 basis points this morning, 436.61. And crude elevated, holding on to gains. Brent crude around 115 all morning. WTI around 100. Annmarie about 30 minutes ago on the phone with the President of the United States. The President saying we're making progress and they're desperate for a deal.
Yeah, he says the Iranians want to settle. He said that's all I can say. They want to settle. It's very different than what we're hearing in terms of what the regime is saying. They're saying that they're not really engaging right now when it comes to the diplomatic talks, which we saw take place over the weekend when it comes to Pakistan. I think the president's Truth Social today basically giving the Iranians one last-ditch effort, because you have to remember, it's not just what the president says, it's what he does. And now there's a mass amount of troops right now that are trained for things like taking over an island. So potentially when the president tells the FT as well, you know, we want all the oil, that means Kharg Island.
For market participants, this is a complex moment. Lisa's talked about this a million times. How do you get an edge in a moment like this? What is your anchor looking at 6, 12 months, maybe beyond? How reliable is the economic data? We've got a week full of it. You'll get payrolls on Friday. The Fed chair speaks later on this morning, 10:30 Eastern time. A lot of people think he's just going to sit this out. Can't really get guidance from the Federal Reserve. They're not going to provide an anchor for you. The data on Friday is not going to provide an anchor for you, because a lot of this is subject to change in the next several weeks.
Which is why things have been swinging around such significant degree. One thing that people are doing is analyzing what they know, which is the earnings expectations that have been going up, which is the reason why Veda, Krishna, as well as Mike Wilson over at Morgan Stanley have been upgrading their expectations for equities. That said, we don't understand the monetary policy response and we don't understand the fiscal policy response. And those are two key components to this entire situation.
Let's turn to the bond market. Think about where we closed on Friday going into the weekend. These kind of levels. A 10-year bond yield at the highest level we've seen since last summer. In the UK, the highest level since 2008. In Germany, the highest level since 2011. In Japan, the highest levels we've seen since the 1990s. Are the vigilantes back? This is what Ed Yardeni of Yardeni Research has got to say. The bond vigilantes are back, taking matters into their own hands and tightening credit conditions. Ed joins us now for more. Ed, welcome back to the programme, buddy. Let's just sit on that, because some people believe that maybe the buying has started on Friday and continued into this morning. Where are you on that?
Well, I think we're going to continue to see bond yields fluctuate at these levels, which are relatively high and relatively tight in terms of their impact on the credit markets. Clearly, we've got a bullish and bearish tug of war going on here. This morning, you folks, Bloomberg has you've posted an article on how bond yields have come down a bit, and suddenly the market focusing on the fact that this oil shock could slow global economic activity. On the other hand, we got to these high levels over the past few weeks on worries about higher inflation, and I think it's pretty clear that inflation is going higher. It's not clear that the global economy is going to be as weak as the bond market would like to see, but we'll have to look. As you said, a lot of known unknowns and unknown unknowns.
For sure. Do you think the fiscal offset that some countries might provide to cushion the energy shock might contribute to higher bond yields from here?
Well, I think clearly inflation concerns have mounted. In turn, that means that monetary policy, which was widely expected to ease around the world, now is expected to not to ease and possibly to tighten. And as you add here, there's also a concern that governments around the world are going to have to spend more on defense, so that's going to increase deficits, and then they might also need to spend more on stimulating their economies if we get a real kind of stagflationary environment with the emphasis on the stags, much slower economic growth.
Ed, we've talked about bond vigilantes coming out of hiding and then quickly going back into hiding time and time again over the past couple of years. Are we really reaching the point at which bond markets are not going to finance some of the fiscal hopes and dreams of developed market nations as they face off with another shock?
Well, it's a good point, and I think the bond market clearly has the attention of politicians. We saw that just last year with Liberation Day on April 2nd when Trump imposed his reciprocal tariffs. And by April 9th, he postponed Liberation Day because of the backup in bond yields. So the bond vigilantes do get the attention of the folks in the White House. And by the way, I think that's one of the reasons they might have postponed their 2-day ultimatum into a 5-day ultimatum and then a 10-day ultimatum, as they were concerned by the backup in bond yields and by the weakness in the stock market. So the financial markets are having a vigilante impact on policymaking.
Perhaps they are, although there is talk right now in Washington, D.C. of Congress coming together with another stimulus package as part of the reconciliation of the current dispute going on. What do you think the market's response would be to that? I'm talking about 10-year yields in particular.
Well, I think it's any continued widening of the deficit, I think, is fundamentally a bearish development. And so stimulus, before the war, we all thought there was plenty of stimulus coming from last year's tax bills, with the refunds likely to be as much as $1,000 extra for a lot of people. And that's still in the pipeline here. So we already have fiscal stimulus. Arguably, we also still have monetary stimulus from the easing that started a year and a half ago, and to provide more fiscal stimulus. And then the president's asked for $200 billion in additional defense spending. Well, that's a billion here, a billion there, it becomes $1 trillion pretty quickly. And we all thought the bond market that kind of learned to live with $1.5 trillion in deficits. Now let's see if we may be stress testing the bond market to see if it can live with $2 trillion deficits at an annual rate.
Ed, always good to catch up. Thank you, sir. Ed Yardeni there of Yardeni Research. It's an interesting situation how consensus has shifted. Coming into this year, consensus view was cyclical bounce. And now consensus view is you won't get second round effects from the inflation spike because the economy's not as strong. I find it difficult to reconcile those two views.
Either you believe that the earnings expectations are going up at companies because the economy is strong and then you've got a pass-through of inflation, or you believe that demand destruction is going to come into play and then some of those earnings expectations have to be overly optimistic. You are absolutely correct. Which is it? And ultimately, this market is not choosing. This market is confused, and rightly so.
Confused, rattled by a war in the Middle East. The president speaking to Annmarie a little bit earlier on this hour, saying that this is going to wrap up pretty quickly based on the conversation you've had and the progress they're making in talks so far.
He says the progress of the war is unbelievable, but then he said they want to settle, which if you're a market participant and the president is saying they want to settle, you would think potentially they do want to settle. But the Iranians say they're not, and you have to remember there's a lot of troops right now, and that buildup has happened over the course of the past week.
I should say indicating things could wrap up pretty quickly, but they've been indicating that for quite a while.
They have, and maybe we're just at another moment where you kick the can down the road for a little bit longer.
The president telling Annmarie Iran wants to settle. Coming up tomorrow, Sebastian Page, T. Rowe Price, and a whole lot more from New York City. Have a wonderful week.